You mentioned trying to stop recessions. How do you do that? I mean, it seems like everything's cyclical in some way.
Well, I have a lot of thoughts on that. I wrote a book with George Akerlof called Animal Spirits, and it's about the psychology of market and recessions. We concluded that, and this isn't totally new, but it's our reaffirmation, that recessions are substantially psychological. So it's difficult for anybody, a central bank, a central government, to deal with them. They're just, it's just like if you get depressed and go to a psychiatrist, don't expect to be cured overnight.
Yeah, I had a question about inverted yield curves. So how do they occur and what do they mean about the state of the economy?
Well, an inverted yield curve is a situation in which short-term interest rates, like overnight rates or 3-month rates, are above long-term interest rates. That's not the usual situation because long-term, well, obviously long-term bonds are riskier because the payout is coming much later. So people generally demand a higher, and the market will give them a higher interest rate. But sometimes it's inverted. It's been shown statistically that that's a leading indicator of a recession. Historically, inverted yield curves tend to be followed by recessions. Right now, we do not have an inverted yield curve, but we're still talking about recession. So it still can happen. But why is an inverted yield curve predicting a recession? Well, one thought is that recessions occur when people get pessimistic. And they might get pessimistic about 10 years into the future. So we were just saying that government bond yields in Japan reached a negative number at the 10-year horizon. It's done that similarly in Germany and other European countries. So what does that mean? Well, one thought is it's just a long-term pessimism. You know, we've been in this financial crisis. It's worse in Europe than in the United States. We've been in it in Europe it's getting close to a decade. And people are starting to think, this isn't going to end. You know, we just don't have prosperity. And they don't want to invest in new projects. So there's just no demand for these. So the interest rate equilibrates at a very low level. The other thing, though, historically is that often central banks started recessions deliberately at times when inflation was getting out of control. That's not now. But in history, there would be times when inflation was just going through the roof and someone said, you know, you got to take tough medicine, shoot the short rate up really high, which is what banks can, start a recession, and that will bring the inflation rate down. And out of desperation, they actually did that. So if that's the story of inverted yield curve, it's not so promising in explaining the current situation when inflation is not a big factor generally.
So are there better gauges of recession in the bond market, like say the LIBOR OIS spread or other basis swap rates? Like what are the good ones, would you say?
Well, I don't like to, the stock market is a famous one. This is the most famous leading indicator. And I tracked it back to the early 1920s. That's when people started to really talk a lot about the stock market as a leading indicator. And I think it became a sort of self-fulfilling prophecy afterwards. In 1929, now people had been talking about stock market as leading indicator. In 1929, we had the biggest one-day crash. I think it was the biggest in history, or very close to that. And so people thought that's a leading indicator. They started to worry about the depression. And that encouraged it to actually happen. People stopped spending and stopped new investment projects. So that's the most famous leading example of it predicting correctly. So we have seen drops in the stock market after 2000, and it led to a recession. After 2007, and it led to a recession. And now in 2016, we see some little drops, you know, not, close to 10% in the stock market. It's starting to get people worried that this leading indicator is suggesting another recession. And it's not just the U.S., it's all over the world. Stock markets have been dropping. But it's still not clear yet because it hasn't dropped really a lot. It might correct upwards. It's very fuzzy. And it's always fuzzy about recessions until they're really happening. Once the unemployment rate starts shooting up, then we pretty much know there's going to be a recession. But it's that period before there's any clear indicators that it's just hard to predict recessions. There's some kind of turning point that happens when people suddenly think, this is it, it's a recession. I better batten the hatches and retreat and protect myself. And then business plans are canceled, people are laid off, hiring is shut down. You can see that when it's happening, and you can predict it's going to get worse for a while. But at this moment, we're not there.
So how do you see that in the bond market specifically?
Well, okay, so the bond market isn't known as much as a leading indicator as the stock market. And if I looked at what was happening in the long-term bond market in 1929, for example, not as dramatic. Or in the housing market then. The stock market is the one that is most famous for predicting. But it's a fundamental fact, though, that recessions are just hard to forecast.
Not for you.
Well, I think it's a little bit like predicting the success of a movie. If I were to show you a private screening of the next movie about to be launched, could you predict whether it would be a hit or not? I think you might think you can, but nobody really can. These things are, even some of the most famous operas, for example, they flopped on their first performance, and people thought they were terrible. But somehow public opinion has its own liveliness. So in our book, Animal Spirits, Akerlof and I emphasized how it's really a kind of contagion of emotion that takes place. About a movie, for example, or a song, that's human nature. And so you can sometimes predict, but not reliably. All right, so I want to talk about real estate. So let me start with mortgage lending. Mort means death in Latin, and so they called it mortuus vadium, dead pledge in ancient times. It's an old idea. The idea of collateral is very old. That is, I'll lend you some money, but you have to sign a contract saying, I can get to sell your land or something if you don't pay me back, and take the money out of that. Otherwise, lending couldn't happen. So that's an old idea. We have it as a verb. To mortgage something, to mortgage your house, means to offer it as collateral for a loan. So when you get a mortgage on your house, the bank, typically it is to buy the house. The bank lends you the money to buy the house, and then, but if you stop paying on the mortgage, they can reclaim the house. Maybe not all of it. They'll sell it, and they'll take what's owed to them out of it, and plus maybe some charges, and then you'll have the remainder. That's the idea. And mortgage lending is very important because they can lend to anybody as long as they can value the house. They don't have to really be able to value your trustworthiness to pay the money back. You could drop dead and they don't care. You're gone. You're not going to pay anything. The house is theirs. At least the component of the house value that they can use to pay off what you owed them. So the history of mortgage lending goes back at least to the Tang Dynasty in China. A little different. Back then in the Tang Dynasty, they could impose fines on your relatives as well. We don't allow that now in modern times. It's only you and your spouse who would both sign. Or sometimes they'll ask your parents to co-sign. That makes it easier to get a mortgage. But they can't go to relatives who don't co-sign anymore. the word mortgage became common in the English language in the late 18th century. And property law wasn't very well developed then because it wasn't even clear who owned property because there wasn't a system that was well established. So if you look in newspapers from the 18th century, you'll see a lot of ads, personal ads, placed there claiming ownership of property. So this is what you do. When you bought a house in 1750, you first would go through all the newspapers and see if there's any ad placed that says, I own that house, this guy is cheating me. And then I have papers to prove it, which would be documents drawn up by a lawyer. So you stay away. It was a mess, though. They didn't have, who owns this house? Well, in Germany, in the late 19th century, they had the idea of having a centralized and authoritative book called the Grundbuch that would list for the whole country who owns what. And when you bought and sold a property, you would have to send the papers to the holders of the Grundbuch, and they would change the ownership. That made it so much better that property now is clear. The title to property is clear, although it's still not completely clear, even in modern countries. Because not all claims on the property get reported, but at least it's getting clearer. So commercial real estate. Real estate partnership is an example of a direct participation program. In order to buy in to a real estate partnership, you have to be an accredited investor, which is defined by the Securities and Exchange Commission in Washington, D.C. As in terms of your wealth and your income. Now, it used to be you had to have more than $1 million of investable wealth in your name, excluding your house, or an income of $200,000 a year or more. That's what a definition of. How many of you are accredited investors? I won't ask for a show of hands. You might have to achieve a certain age, too, to be an accredited investor. But the idea is we will protect the small investors against fraud and being cheated because they don't have lawyers. They can't afford lawyers and advisors, and they're so vulnerable. But if you're rich, the government says, all right, you have your advisors. We'll let you invest more generally. Other countries have similar divisions, so it's not just the U.S. It makes sense, right? You have to protect ignorant people, and not everyone is smart. We can't let crazy schemes prey on them. Okay, so a real estate partnership is for accredited investors, and a limited partnership means you have limited liability. At least the limited partners have limited liability. Direct participation are flow-through vehicles. They escape corporate profits tax, but their profits become your income. The IRS has various requirements. One of them is that a DPP can't be perpetual. It has to have a limited life. Corporations derive a lot of their value from the fact that they go on forever. Once a company establishes a reputation, it has value that will last maybe hundreds of years. Or if not that long, at least many decades. But a DPP is supposed to be for a particular life. That means, for example, you would buy an apartment building, a typical DPP. You'd get a small number of partners, rich people who buy into your partnership. And then you say that in 20 years we'll sell the building. And then we close down. So you've satisfied the IRS requirements for a pass-through vehicle, and you don't have to pay corporate profits tax, which is a big advantage. The general partner runs the business and does not have limited liability. Must own at least 1%. Limited partners are passive investors, just rich people typically, and they can replace the general partner. and they sell units to investors and give performance-based compensation to the general partner who's taking the risks. Now, there were complaints about these limited. They were trying to protect small investors, but when that left small investors unable to invest in real estate. In 1960, the U.S. Congress created something called a REIT, Real Estate Investment Trust. And I believe the U.S. was the first country, but I shouldn't say that I know that. There's so many things that happen. Often, the U.S. is not the first to do something, but it becomes a leader in finance, a leader toward a movement, so something will happen. But it was new, definitely in the U.S. in 1960. So the complaint was, a little guy, just can't invest in all these buildings that have been making so much money for rich people. It's unfair. So the U.S. government created a new kind of investment vehicle called a REIT that would be available to small investors, and they'd be regulated to be safe. Well, it wouldn't necessarily be safe because they're investing in real estate, and if the real estate goes bad, but at least they won't be taken advantage of. And they also get the tax break. That if you could have set up a corporation before this that owned real estate, but they would be paying corporate profits tax. So now REITs are getting much bigger. They've been over half a century now, and they're now in many countries. But U.S. is still the biggest source of REITs. So the law restricts REITs. They're not going to pay the corporate profits tax, so they don't want to let corporations call themselves a REIT. A company could say, well, we own real estate, we own the factory, and so we're a REIT. No way, you can't call yourself a REIT to escape taxes like that. So they had to define it. So they've defined it that 75% of the assets must be in real estate or cash. And 75% of the income must come from real estate. And 90% of their income must be from real estate, dividend, interest, and capital gains. And 95% has to be paid out. Now here's where the dividend earnings ratio is set by law. They've got to pay out their earnings. And also, they wanted to discourage no more than 30% of the income from sale of properties held for less than 4 years. They wanted it to be long-term investing, not turning over rapidly. So starting in 1960, there was a REIT boom, and that was followed by a recession and a drop in property prices into the early 70s. There was a second boom after the tax reform of 1986, eliminated many of the advantages of partnerships. It used to be that DPPs could do fancy arithmetic on the pass-through taxes that you got, which would make them very advantageous. Notably, you could depreciate by favorable rules that reduced your taxes, even if the depreciation wasn't real. So they made it less profitable in 1986 to invest in a DPP. And then there was a third boom starting in 1992 when many companies, after the, this is also a time when a lot of specialized REITs developed to appeal to investor interest. So you can buy a golf course REIT. Remember, real estate is both structures and property. So golf courses apparently satisfy the idea of investing in property, and you can do a golf course REIT, or many different kinds of REITs.
You describe how human psychology explains a lot of the price movements in housing and real estate, but if we don't consider those, if we absent any psychological factors, what would the long-term housing price index look like?
Okay, I never actually went through that exercise. If you look in my book, I have a plot of home prices since 1890 and construction costs since 1890. So maybe it would look more like construction costs. Remarkably, if you correct for CPI inflation, construction costs haven't gone up a lot in 100 years. In fact, for the last few decades, they've been sagging. Why is that? Well, I think it's because there's technical progress. We mass produce things now. They used to plaster by hand on lath. Now they put drywall up. It's cheaper and quicker. Things are pre-made. You just stick them in place. Mass produced. So that limits the rate of growth of construction costs. And I think prices, if that were the only factor, then prices would look like construction costs. That's what people often have said. Economists have often said that prices are just driven by construction costs. But those economists wrote before the recent bubble in home prices. I think they're getting more, they're more psychological. There's more attention. The psychology of the housing market has changed. If you went back to the 19th century, it's hard to find many real estate bubbles. But you do find them, for example, in the 19th century in Manhattan and Los Angeles, and a few other places as well. But what did Manhattan and Los Angeles have in common? They were glamorous places. They were glamorous back then. Yeah. Beautiful weather in Los Angeles. And also a shortage of space to build, at least especially in Manhattan. So in those places, they had housing bubbles, but not everywhere. So something happened in the late 20th century that got people, and not just in the US, in many places, got many people thinking that real estate was really going to be scarce. I think it had something to do with the free market revolution that started in Britain with Margaret Thatcher, and in the United States with Ronald Reagan, and then in China with Deng Xiaoping. There was a move over much of the world toward free markets, which I think on the whole was a good thing. But it also had its consequences that it led people to think, you know, we used to be a society where we appreciated the working man or woman and we would protect them. Now everyone's got to watch out for themselves. And they started to have a fear that housing would just get beyond affordability. And that kind of is still with us, that homes prices are just going to go way up, and you better buy now. Now, you don't see that so much. I look through old newspapers for ideas like that. Maybe in Manhattan. If you want a house in Manhattan, I remember reading from the 1880s someone saying, you know, it's hard to find a building that's less than 6 stories tall that's going up now. You can't just buy a house in Manhattan anymore. And it's still true. It's still expensive there. Mortgages. Now, mortgages are mortgages owned by households was recently $13.2 trillion. And recently there were 48 million in the United States, 48 million mortgaged homes. But that's 1 for every 6 or 7 people. A lot of people still rent and live in apartments, but there's 48 million mortgaged homes. Now, there are also problems in the mortgage industry because in 2012, right after the financial crisis, when the housing market bottomed, there were almost 11 million homes that were, quote, underwater, which means the value of the home was less than the value of the mortgage. That's quite a startling number. So that was 1 in 5 homes. What would benefit people who lived in those homes would be to abandon the house. It's called jingle mail. You put your keys in an envelope and you sign a short letter to the lending bank. I'm out of here. Take my house. And you go and you rent. Now that only works legally in what are called non-recourse states. So some states are recourse, they can go after you and try to get your money anyway, even beyond the house. But many of our states are non-recourse. And even if they are recourse states, they won't actually often go after you because it's too expensive and you don't have anything else typically. So why bother? They write it off as a loss. But most people don't. Most people keep paying. They live in the house. Maybe they have some ethical concerns. I promised to pay this, I'll pay it. But it left our economies in shambles because these people typically knew they were underwater, so they knew that they had negative savings. The typical homeowner, especially younger homeowners, have nothing more, virtually nothing more than their house. And if it goes underwater, that means their personal net worth is negative. So we had, like 10 million families with negative, something like that, negative saving. And that's what killed the economy. They didn't want to spend money when they don't have anything, less than nothing. So they just sat in their house and they continued to pay the mortgage and they didn't spend. So the whole economy went down. In the 1920s and before, there weren't as many mortgages. The industry wasn't as developed. But the mortgages that you got were typically 5-year term loan or less. You might get a 2-year loan or a 3-year loan to buy a house. Now, of course, you're going to live in it more than 2 or 3 years, or often would anyway. But how do you deal with it? Well, you have to just come back and refinance. The bank says, no problem. In your mortgage, we're giving you a 2-year mortgage to buy a house. In 2 years, come back and we'll give you a new loan at the then prevailing interest rate. The problem was, in the 1930s, we had the Great Depression. And it involved a crash in home prices, because everyone was poor. They couldn't pay as much to buy a house anymore. And secondly, it produced 25% unemployment. So now, 2 years have passed. You bought a house in 1929. It's now 1931. You're underwater. You go back to the bank and say, I'd like to renew my mortgage. And the bank would say, no way. You don't have a job. Your house isn't worth as much as the mortgage. So they would just foreclose on you. So millions of houses were foreclosed in the early 1930s. That led to the Roosevelt administration. They created the Federal Housing Administration in 1934 that would insure mortgages. That is, insure the bank against your default. So the government was taking on the risk that had formerly been on homeowners. That's because the whole thing was a total mess. Houses were worth much less. Nobody could buy them. They were crashing. And that made banks fearful of lending to anybody. So Roosevelt took a big gamble. He said, we're going to just insure them, we the government. And if there's further defaults and further crashes, well, we're going to take it out of taxpayers and we'll pay you off. So the banks started lending again, and it brought the housing market back up. The other thing that Roosevelt did in 1934 was to require 15-year loans. Any FHA loans had to be 15 years till maturity or longer. This whole idea of giving you a 2-year mortgage seemed like a bad idea in 1934. That established a trend toward long-term mortgages. As time went on, it became standard in the United States to have long-term mortgages. And now typically it's 30 years. At least if you're a younger person, you typically get a 30-year mortgage. By the way, FHA has been in trouble recently, and it may still be in trouble, but it hasn't defaulted yet. So there have been a lot of mortgages that had to be paid out by the FHA that defaulted. And so they've raised their insurance premium from 0.5% a year to 1.5% a year, which has been hurting real estate.
Since the 2007 housing bubble, markets seem to be concerned overwhelmingly with irrational overvaluation of aggregate housing prices. My question is, should we rather be concerned about irrational undervaluation of housing prices?
That's a question especially for certain cities like Detroit or Baltimore, where prices have Well, I don't know if they've fallen much in Baltimore. Maybe
in certain pockets.
certain pockets. But Detroit has had prices fall so much that the city has been tearing them down. They hit zero and they're abandoned, and then they've become a hazard. So I guess it's like anything else. You have to judge whether they're being devalued for a good reason or not. Detroit is coming back now. So it might have been a smart move to go in and buy them recently, and you could get them really cheaply. And then maybe they will come back. It's like anything else. Value investing has to judge. You can do value investing with housing, but you have to judge whether there's a prospect of them coming back. I'm sure there's a strategy for doing that. Maybe I'll buy some property in Baltimore.
Let me know.
You said you're from Baltimore.
I am.
Yeah, so the thing about mean reversion, when something gets really cheap, it has a better chance of coming back, but not necessarily. It's a somewhat risky investment. But yeah, homes, there are a number of places where some people argue price has fallen well below construction cost. And so there won't be any new construction if the houses are selling for less than it costs to build them. So those might be good investments in the longer run if the city gets rediscovered. New jobs start coming into the city, and then suddenly those properties would take off. And they're protected against new construction. See, if homes are selling well above construction cost, there's a kind of a cap on their appreciation. I don't know if a lot of people realize this. They can't appreciate too much because builders will come in and build more of them and dump new supply on the market. So there are people who look at these and invest in housing, trying to find houses below construction cost in areas that are coming back. And that might be a good investment. On this slide, the red line is the 30-year mortgage rate. It's the rate of interest on the 30-year mortgage. And the blue line is the yield to maturity of a 10-year U.S. government, federal government treasury bond. And I put the two together on this chart to illustrate an important fact. That the 30-year mortgage rate tracks the 10-year government bond yield. It's a pretty good relationship, isn't it? Well, the reason that there's a good relationship is that there should be one interest rate, right? Now, let me clarify one thing. 30-year mortgage, that looks very different from 10-year. But most mortgages are paid off in less than 30 years. In fact, this is the way it works. The typical homeowner, that's you coming up, the typical homeowner buys a first home, which we call a starter home, when they're in their 20s maybe. And then their jobs tend to be unstable at that. They're moving from one job to another, and they might move several times in the space of 10 years. And then typically the normal life cycle in an advanced country is by the time you reach 40 or thereabouts, you've now settled down in a job that will keep you for 30 years. Not always, but typically. This is a typical life story. And then you buy a house which is your final house, which you live in for 30, 40 years. And then you end up moving to some kind of retirement community. And then you move to a nursing home. And then you move to the cemetery. That's the life cycle. But look at the housing purchases there. There's a lot of short purchases, and then there's a long one. But we give these people 30-year mortgages even if they're buying a starter home. They never know it's a starter home. They don't like to bring that up. You're buying a home. You're excited, we hope. You've got a house now. And they know that you're going to probably sell it. So anyway, the average time that a mortgage actually is outstanding is something like 10 years, even though it's a 30-year mortgage. So they like to track, they're doing this deliberately, they're tracking the 10-year mortgage rate. Now why is there a spread though? The mortgage, I said, they're tracking the 10-year government bond yield. Now why is there a spread? See, the bank is charging more than the 10-year rate. Home mortgages are slightly riskier. Yeah, you can see it. Now incidentally, there is, some of them are FHA insured, so, and there's other mortgage insurance, but they have to pay for that insurance. So it's not, we just said it's up to 1.5%. The spread between the two is getting wider now than it was back then. And I think that reflects the costs of, and also a mortgage has to be serviced. You have to send out letters, you have to maintain a system. When people don't pay, you have to call a credit bureau that will nudge them to pay. So all those are costs. But I find it amazing. The 30-year mortgage rate in 1982 got up to almost 19%. Okay, that's the interest rate on the mortgage. This is the mortgage rate. But your mortgage payment would be more than 18. If you borrowed, let's just to make it simple, you borrowed all of the money to buy a house. Let's say you bought a $300,000 house. And let's say the total mortgage payment is 20%. So what's 20%? That's $60,000 a year. That's a lot of money, isn't it? How did people do that? A $300,000, of course, back in 1982, $300,000 would be an expensive house. We could still do that. That's a lot of money to be paying out every year. You know how they did it? Well, A, they didn't do it. Home prices fell because nobody could afford to buy a house. Some of them did it, and they got their mom and dad's money to buy a house. And I was there. I did that. I bought a house in, what was it, 1982. We weren't paying that. Of course not. That would be a huge sum. Yes, Gar.
Are these interest rates nominal or real?
These are nominal. Yeah, and there was a lot of inflation. But you see, the problem, it doesn't matter whether there's a lot of inflation or not. Yeah, you're being paid back because ideally your property is appreciating with the inflation rate. But that's not cash that I have. I have to pay this mortgage. Yeah, high inflation and high nominal rate periods bring in high mortgage rate. It makes it difficult to buy a house. But there are other kinds of mortgages. No, so what is prompted by your question is the so-called price level adjusted mortgage, or PLAM, which tried to make the they made the amortization actually negative. Amortization means paying off the principal. Your payment comes in two parts. One of them is interest, one of them is amortization. So they had negative amortization mortgages in the first year, so you didn't have to pay 20% of the value of your house every. How can anyone afford that? So PLAMs started to come in this really high inflation period. The inflation rate was double digit in 1982. Then there's all these different, and that kind of adjustable rate mortgage is a mortgage that you get it for 30 years maybe, but they don't fix the interest rate. They tell you that your interest rate would equal some short rate, like the 1-year treasury, each year plus something. So it fluctuates with interest rates. Dual rate mortgages, I don't know if they even exist anymore. PLAMs, as far as I know, don't exist. There might be some. You might, if you asked around, be able to get one now. But inflation is virtually zero now, and so people completely lose interest. They shouldn't, by the way, because we're going to have a lot of inflation in the future, probably, sometime, and but people get kind of unconcerned. The banks are unconcerned. If there's a lot of inflation and you own a house, you're happy, because now the real value of your mortgage goes down. If it's a fixed rate mortgage, but the bank won't be happy. Then there are shared appreciation mortgages. These are mortgages where you pledge some of the, you pay out some of the appreciation in value of your house. in lieu of interest. These were popular in the United Kingdom just before the financial crisis, or just before the 2000s. But they dropped out of favor because home prices went up so fast in the UK, and people were promising to pay that, and they didn't like it. And they got angry, and the whole thing kind of fizzled. So, we're still back mostly in the United States with conventional fixed-rate mortgages. A home equity loan is a loan on the value of your house that you might take on later as a way of getting money. So, for example, for home improvements, or you might just take out a second mortgage. And they're often marketed separately. They were part of what got us into a great amount of debt just prior to the financial crisis, because people were, first of all, borrowing at a conventional fixed-rate mortgage, and then they get an ad saying, do you want a vacation? We'll lend you against the value of your house. So people started borrowing more and more against their house. We had fewer people who had paid off their houses and more debtors. And then the financial crisis came.
Would you consider inflation being one of the major causes of, the depression of housing values?
Well, when you bring that up, it brings to my mind the episode just as Paul Volcker became chairman of the Fed in 1979. There was double-digit inflation, like 12% in the U.S. at that time. And so interest rates were very high. Some people were paying 18% a year on their mortgage. It became very difficult for people to afford that interest. And so home prices reached real extreme lows at that time. But they came back. So it's plausibly due to inflation and to the absence of PLAMs, price level adjusted mortgages, that might have made it easier for people to borrow to buy a house. I remember I said that in 1934, the United States government decided to insure mortgages of a certain kind through the FHA, Federal Housing Administration, and later through the Veterans Administration for veterans. The government would merely tell the mortgage lender that if this guy defaults, we'll pay up, so don't worry. So these people, they wanted to make sure that people who fought in the war and came home wouldn't be handicapped by their being out of the business world. That makes sense, right? Veterans should get some special preference. But that led to private companies that also did insurance on mortgages. And then you pay for it. So when you get your first house, you'll have a mortgage payment that subsumes the PMI, private mortgage insurance. And that insures the lender. But you have to pay for the insurance. You, the homeowner, pay for it if the down payment is less than 20% of the value of the home. And it usually is. Now, there was a controversy. This is more manipulation and deception. It's not really deception. It's failure to notify you. You would think that the mortgage lender or the mortgage insurance company would notify you when the value of your house is probably over 20, value of your house went up, so now the down payment is, your mortgage balance is less than 80% of the home value, and tell you to cancel, but they don't. Many people continue to pay for PMI long after it was necessary. That's capitalism. They have no incentive to notify you. They also didn't necessarily hold enough reserves. So in the financial crisis, at least one of them, PMI Group, Inc., declared bankruptcy. So insurance companies are not necessarily reliable. So the CMO is I think I was starting on this last time, when a bank issues a mortgage, it's a loan, so it's a piece of paper with a certain value. They can sell the mortgage to somebody else and typically continue as the servicer of the mortgage. Namely, you send your mortgage check to them, and if you don't pay, you get a call from them or from someone they subcontract to call you. But the owner of the mortgage is different. Now it's an investor. A CMO is a collateralized mortgage obligation that is a pool of mortgages that is sold to investors like you. You could invest in one of these. But they also divide them up into tranches. I think I alluded to this. The senior tranche gets paid first. If there are defaults, it affects the senior tranche only if all the other tranches have been wiped out. So they might have a AAA tranche, then a AA tranche, and so on, that are not rated as highly. And it helps them sell these securities, because many investors are required by their charter or their sense of obligation to invest only in AAA things. So CMOs, an ordinary securitized mortgage would not have a AAA rating because the homeowners might default. But if you divide them up into tranches like that, you can get AAA securities out of them. The last tranche, the worst one, is called toxic waste. And these are the ones, it's probably not worth anything, or very likely not worth anything. And hedge fund investors might buy those if they at a price, really low price. So they take all the risk, but presumably they understand it better than you, the investor. So what is a CDO? It's something like that. It does the same thing. It divides up into tranches. You might think of CDO as just a more general category. They don't have to buy just home mortgages. They can buy auto loans or any kind of debt. There's also some technical legal definition that I won't get into because this isn't the Yale Law School. But both CMOs and CDOs went into default. They reached into the higher tranches during the financial crisis, and that was I said 2007. It's 2007, 8, 9, maybe 10, 11, maybe even now we could still say we're in it. I don't have a good name for it. But what we do know is that these CDOs and CMOs dropped in price. Actually, they dropped in price too much. The AAA tranches shouldn't have been rated AAA, but they weren't as bad as all that either. People panicked because of the crisis. So it was a good investment in 2009 or around then to buy low-priced CDOs and CMOs. You have to be smart. Once again, I don't believe the efficient markets hypothesis that everything's priced right, especially at a time of crisis when everything seems up in the air. And this is a time when deep knowledge of institutions and people help you. That you have to kind of be in a swim of things, know what's going on in Wall Street. Know in 2007 that those ratings that the rating agencies give are bunk, so you don't buy them. After they're beaten down, then you go in and buy them because you know it's not that bad. So that's how the smart money outperforms. Now, after the financial crisis, the people were really angry that the CMO and CDO people had repackaged mortgages and sold them to the general public, and that the banks who sold the mortgages didn't really care whether they were good or not, because they weren't going to own them. If you're in the mortgage origination business, you're a banker that makes mortgage loans, and you know you're going to resell it to some ignorant investor, then you say, what's the point? I'll approve everybody. I'll make maximum amount of money. So this was the period when, among other things, the liar's loan appeared. That's a nickname. That's not what it was officially called. But a liar's loan was a mortgage issued to a person who did not show evidence of having a job or having a good record. They just took the guy on faith. Maybe they faked it and said that they did have evidence. This is a crime to do that, right? To take out a mortgage that you think is highly likely to default, to get a credit rating which is not careful at all, and to sell the securitized mortgage to ignorant people all over the world thinking that they're investing in a sound enterprise. So in Europe, the European Parliament passed a rule that a mortgage originator must hold 5% of the mortgages that it initiates. So if you're a bank and you issue mortgages, you can't sell the last 5%. That gives you an incentive to stay above level and not to give liar's loans, for example. Here's an example of the US copying Europe. In 2010, the Dodd-Frank Act copied this idea. But it said that we won't require that if the mortgages are qualified residential mortgages. So the term qualified residential mortgage was defined by the Dodd-Frank Act. Actually, it didn't fully define it. The Dodd-Frank Act said the appropriate regulators will have to come up with a definition of a qualified residential mortgage, which is a mortgage that is where all the right things have been done by the originator, the lender, to assure that it won't default. They also, this is funny, Dodd-Frank Act is very difficult to read, and I have to admit, I haven't read all of it, but it's almost 1,000 pages long. And it's not written to be readable. Have you ever tried to read legislation? They'll say something like, in the something act, the Credit Act of 1940-something, line such and such is hereby stricken, and the words are replaced with. So in order to read this stupid thing, you've got to go back and forth between all the other legislation to figure out what the other one said. So it's complicated. And it leaves all these open ends. So the Dodd-Frank Act said that you as a mortgage originator have to hold 5% of the mortgages you issue or more, unless it's a qualified residential mortgage, as will be defined in due course. So they left it to the regulators to say, you have to define what is a qualified residential mortgage. And that means a mortgage that has been done properly so that we can be reasonably assured that the homeowner won't default. So they brought this up to the, now it turns out there's multiple regulators of mortgages, and they couldn't get their act together. They started issuing proposed rules. That's what they do. Before issuing a definition of qualified residential mortgage, they put up on their website, we're thinking of this definition. So what do you think happens? Every banker in the country gets onto it and writes a complaining letter. So it's such a mess. You can get onto the website and see. I think for the QRM definition, they got over 10,000 comments. They call them comments. Often angry complaints. You can't do this. I can't stay in business if you put that definition on. So it took them 4 years to come up with the definition. Originally, they had a 20% down payment requirement. They've dropped it. So I tried to read the rule. I tried to read it. I discovered it was taking me a long time, so I went to the end, and it had 689 pages to define a qualified residential mortgage. That's a lot of pages. Well, you get lawyers, and get them going, and you get all these bankers arguing about it, and all their lawyers. It gets very complicated, but at least they did it. And so here, this is not reading the 689 pages. This is a summary from a mortgage website. So this is, now incidentally, you don't have to adhere to these rules, but you can't sell all of the mortgages if you don't. And so bankers pretty much are all going to follow these rules because they don't want to be stuck with something that can't be sold. Bankers have to sell the mortgages to get money to make new mortgages. They're in the mortgage origination business. And mortgages are inherently not held by banks, somewhat by banks, but often not. So they just generally want to qualify. So that means that you have to have equal payments or substantially. You can't have no payments at the beginning and then payments later, because that would be attracting borrowers who don't have the money, right? Or it would be confusing borrowers. They might think that the low payment is forever. No negative amortization. That means, remember we talked about amortization, and that price level adjusted mortgages that were tried in the 80s had negative amortization at first in nominal terms, because the interest rate was so high that nobody could pay that. In a high inflation environment, you have a fixed nominal payment for 30 years, but inflation is going up at 10% a year. prices are going up at 10% a year, that means the real payment is going down. So the real payment is declining through time, but the nominal payment has to be constant now. So you can't have negative amortization and qualify anymore. And balloon features. A balloon payment is a payment at the end. You can't have a payment at the end. It's got to be an annuity. You can't go over 30 years. You can't have points, which are fees of a sort, that exceed 3% of the total loan amount. Also, interest rate is sometimes adjustable. You have to use the maximum interest rate that may apply during the first 5 years to define debt-to-income ratio. You have to verify the consumer's income and assets and current debt obligations and ask whether the borrower has alimony or child support payments to make. And finally, they did not put a loan-to-value ratio test. In other countries, they'll do. They say you can't loan more than 90% of the value of the house. QRM rules don't have that. Instead, they have a debt-to-income ratio. So that is, you cannot have a debt which is more than 43% of the borrower's income. So that's QRM. And I'll end with that. These rules are kind of obscure, and I went over them, though, because you're going to be buying a house. How many years before you start buying houses? Won't be long. And you want to know these things. This is what you're going to get. You're going to get a no negative amortization, 30-year mortgage with a debt-to-income ratio less than 43%. And you know what questions they're going to ask. So this shows how regulated our economy is. It's a nice tie into our next lecture on regulation. There have been, in history, many banking crises where banks are subjected to a run. Depositors lose faith in the bank, and the bank runs out of money. During a bank run, everybody goes to the bank and demands their money at the same time, and banks can't handle this. So government regulators long ago imposed in the United States and in other countries reserve requirements that banks have to keep a certain amount of cash on reserve to meet any sudden increase in demand from their depositors. And so the government then put a requirement that was binding. Banks would hold some reserves anyway because they recognize the risk, but the government in the United States put reserve requirements high enough that banks were forced to hold more than they wanted. Excess reserves are the reserves that banks hold beyond what they're required to hold by regulation. And it's an interesting chart. They never did hold any excess. Well, actually, you can't see it.
Right.
But there's a little blip. Yeah. But basically, when you make a regulation, it's either binding or it's not. If it's binding, that means they don't want to hold that much. Why don't they want to hold excess reserves? Well, because they didn't pay any interest. And so banks like to lend out the money, so they didn't want to. But then suddenly they started holding excess reserves. And why is that? Very simple explanation. You see this gray shaded area, that represents the recession. In fact, this is the Great Recession. These are relatively minor recession. This is the big one. And it was so bad that in many countries all over the world, central banks cut interest rates as far as they could, and that was zero, in order to stimulate the economy. So the problem is, now banks don't care if they can only invest at zero.
It's like putting it under your mattress.
Yeah, the banks have no place to go with this money.
Right.
So they think, well, we'll just leave it in reserves. We don't care. So we're holding much more reserves than the central bank requires. And you can really see it. They were holding, this is in millions of dollars, so this is a huge, a huge amount of money held in reserves. And it has just keep going up. It's really remarkable that there's so much cash just lying around now, not being lent out, and interest rates are, well, they've come up a little bit. This chart ends But they're so close to zero anyway that banks don't see lending opportunities that appeal to them. Also, regulation has made it harder for them to make risky loans. This is the source of our concerns about what's called secular stagnation. That there's something different about now compared to any other time, going back decades. What's different is there's just no place to invest. You wouldn't leave money lying around earning zero interest. These are professional finance people running banks. They're letting it just lie there earning nothing. So it's a sign of some kind of fundamental weakness in the world economy that came on with the financial crisis. Moral hazard and adverse selection are fundamental issues. Let's put it in the context of fire insurance, all right? If you open up a company that insures homes against burning down, you run two risks. One of them is moral hazard. That's the risk that one of you sold a policy to someone who owns a house to insure that house against fire. Then the person deliberately burns the house down in order to collect. That's a real problem. Because, now, you might be able to prove that it was arson, but maybe not. Maybe the guy can make it look real, normal. So the protection against that kind of moral hazard is don't insure the full value of the house. Make it always in the interest of the home buyer to sell the house rather than burn it down. The other thing is adverse selection. If you're doing fire insurance, even if people are moral and ethical and they won't play tricks on you, it could be that people might know that their house is not fireproof, that their house is in danger of burning down. So all the people will flock to you who have homes that are in danger of burning down. And so you will get a selected part of the potential insurance market. The worst, it's always the worst for you. So what do you do about that? You have to carefully examine the kinds of properties, and you get a fire expert to look and see whether this house is different from others. And you have to then maybe add a little bit more to the premium than you would normally charge because you're worried about the adverse selection. Now, how can I relate it to this? Now, some people will say when they look at this that all this money is sitting in the bank's reserves, not earning any interest. But then I say, I look around, I can see interest rates that are higher than that are higher than zero, well above zero. Like, for example, so-called junk bonds. They might pay an interest of 10%, even now. So what's going on here? Well, this could be considered adverse selection. If you go to at this time in history when interest rates are practically zero, and you go out and say, oh, no, I'm going to invest in high interest rate loans, you might be suffering an adverse selection problem. You might be suffering the problem that some of these borrowers are going to burn their house down, or they're very subject to fires or disasters. And so you will always see what look like investment opportunities. But to professional bankers, they're not opportunities. You can, as a bank, you could advertise. You know, we're making loans at a good interest rate. Who's going to come to you? If business is bad, it's going to be these, I hate to say it, losers, people who are not good prospects. So the banks then, because of fear of adverse selection having gotten worse, when nobody else is lending, you think, am I going to be the guy who goes out there and makes these loans? Not now. I'm going to wait too.
And so in both of these cases, there's kind of either an asymmetry of information or the inability to monitor, let's say, the homeowner when you're insuring them.
Right.
So in the same lecture, you'd also mentioned a very key point that the institution of banking is, in some ways, helps to mitigate these frictions. Right. And so I was wondering if we could kind of talk about that a little.
Any business in insurance or banking or finance more generally has to worry about adverse selection, moral hazard, and they have to worry about their being manipulated or deceived. So what you need is a business that invests in information and invests in relationships, trusting relationships. So a bank, a well-run bank, will have local offices in every city. The local banker then gets involved with people in that city. He or she plays golf with them, hears the gossip, gets to know important people in that regional economy. And then when someone comes for a loan, you can call up your friend and say, what do you think of this guy? And then you develop a relationship with the borrower as well. You have coffee with him, you say hi when you meet him on the street, right. And you can judge the expression on his face, whether he's doing well or not. And bankers then use their gut intuition and their information to decide whether to make loans, whether to take risks. But I wanted to talk about the real estate bubble, which is a favorite topic of mine. I should say it's a depressing topic, but it's interesting, like a disease. It's a disease of the economy. And I don't like the bubble itself, but I like to study things like this. So I think I told you before that when I wrote the second edition to my book, Irrational Exuberance, I wanted to find a long-term, say 100-year price series for homes. And I discovered there was none in any country. So I constructed one for the United States. And it attempts, it's not the average price of a home or median price of a home, which would be misleading because homes have gotten a lot bigger and better. It's the resale. It's a repeat sale index that looks at repeat sales of individual houses to measure price changes. And this is the index that I produced with Carl Case at Wellesley College, and then my student Alan Weiss here at Yale wanted to start a company, so we started Case, Shiller, Weiss to publish these indexes. So the blue line here is the home price index from 1890 to the present. I published it in 2005 when we were right here. And I said, in my 2005 edition, I said, something is really going on right now, which is unprecedented in US history. Except, well, the only precedent is this one here. The baby boom, yeah. So after World War II, the war was over, and the US wasn't damaged in the war. The soldiers came home, and what did they want to do? Well, they had but by the way, during the war, they couldn't build any houses by law, well, except military housing or housing for factory workers. You had to get the War Production Board to approve any house. And you know what they approved? A tiny bungalow with one bedroom, and that was it. So there were no houses. You wanted 2 bedrooms. You have a baby now, or you're hoping to have a baby. So there was a shortage of houses, and they bid the prices up. But that was a totally different boom. That was understandable, right? World War II. Also, right around the peak, people started into a buying frenzy because of World War III, as they called it. The Korean War broke out in 1950. And I think I might have mentioned this before. People panicked thinking that they're going to shut down home building again, so I need my home now. But the funny thing is home prices didn't really fall after that, not very much. It wasn't the same thing. It was all about war and government restrictions on housing. This one was different. Something was going on that was unprecedented. And I'll tell you what it was. Partly it was fraudulent mortgage lending. It was also not fraudulent mortgage lending, but it was over-optimistic mortgage lending. Somehow people thought that prices would go up forever. and just a boom, just a bubble. You wonder, why did it happen when it did? Well, it sort of happened on two prior occasions. This one here was a bubble in the 80s, and then it crashed with the savings and loan crisis. There was some fraud and manipulation in this bubble as well. This one, there wasn't everywhere. It was in Texas at first, and then it was in California, in some East Coast cities. So it didn't really catch on as big. And then this was another bubble that peaked in 1990. But then it really shot up. So like these were practice runs, trial runs. The idea spread everywhere in the United States. Not just in the United States, though. I might say this was happening in lots of countries around the world. And it wasn't driven by building costs, population, or interest rates, which weren't doing anything. So I think it was a speculative bubble that preceded and led to the financial crisis. Then home prices really crashed. These are real home prices, by the way, corrected for inflation, until 2012, and then they started going up again. So now, this series, I may have said this before, showed no increase from 1890, or virtually no increase, from 1890 until sometime in the 1990s. This is around 1997 when it started going up. So we had 100 years of no home price increase. This is important to understand because it's contrary to most people's intuition. Most people would think as the population grows and the economy grows, homes would just keep going up in price. Well, there is some truth to that. I mean, we have limited land, and people especially like to live in cities, established cities, where they have jobs. So there's some truth to that. But offsetting that is that our technology for building homes is getting better. And so we can mass produce things more. We can build them more efficiently. So we don't need to do all the expensive things to maintain a home. You can see that building costs have not been going up, in fact falling for the last half century. And the building costs might go up because of labor costs, but labor is only part of building. So it's kind of, building costs are kind of stable. They've gone up a little bit in 100 some years, but not a lot. So if you can build them, there's no problem. And the price of land is actually a rather small component of home prices, at least if you get outside of major cities. So you're building a structure, and structures depreciate and wear out, and they go out of fashion. So people don't want them anymore. In fact, they'll tear these houses down sometimes when they buy them and put up a completely new house. So it doesn't, home prices don't tend to go up. But somehow, in this period, in the 1990s and early 2000s, home prices were just seen of as always going up. It had something to do, I don't know, with the culture, with the story about the emerging world, about the rich Chinese or rich Russians or whatever they are coming in and buying our properties. They just got exaggerated, and so it led to a bubble. So this is a figure from the book you have, Irrational Exuberance, 3rd edition, that I came out with in 2015. And what it shows is, well, first of all, that's just the same home price series, but just since 2003, the same home price series you just saw. Doesn't look as dramatic since it's a short clip of the longer series. But you can see the home prices peaked in 2006, and they started falling after that. But the other thing shown is the percent of new home buyers who agreed with the following statement: real estate is the best investment for long-term holders who can buy and sell through the ups and downs of the market. That's a cliche. I mean, it's usually done with stocks, but I thought, why don't I ask the same thing of real estate? Now, these people just bought a home, so they're likely, it's called wishful thinking bias. They're likely to think that their home was a great investment since they just made it. it would be cognitive dissonance if they answered otherwise. But you can see how these were always new home buyers in every year that I did this survey. And you can see that it kind of moves with home prices. When home prices have been going up, so has their agreement with this. And when home prices start going down, they start losing their agreement. So this is evidence of a bubble, okay? We had initial price increases on homes in the 1970s. They were doing really well as investments. People just don't look far back. And part of the reason they don't look far back is nobody shows the data. They don't show, I find it absolutely flooring to think that nobody had ever constructed a 100-year price series. The newspapers don't publish 100-year long time series. They're not interested. It's not what people seem to think they want. So you only see, a few years and you see it's just going up like crazy. And so you make the mistake of thinking it always will. That's how we. Now the housing sector has a big impact on the economy through residential investment. Residential investment in the GDP accounts consists of building of new houses, new apartment buildings, and improvements like additions to houses and apartment buildings. So the red line is housing starts in thousands of units. It's a monthly series. SAAR means seasonally adjusted annual rates. So you can see how variable it is through time. Also shown on this chart is my real home price series, which is the Shiller, S&P Shiller series starting in 1975. And for the region before that, it's an old Bureau of Labor Statistics home price series that they've discontinued. But I've got it for that period. So I have a home price series. And you can see that housing starts are very variable, and they have something to do with home prices. Not surprisingly, when home prices are high, you're a builder, right? You want to know, what can I sell this house for? When home prices are high, my profit margins are high, so I'm going to dump houses on the market when home prices are high. And I'll stop doing it when they fall. Well, it doesn't explain housing starts that well, but somewhat well, right? You can see there was a big housing boom in the early 70s, and there was a price increase as well. These are prices of existing houses, not new houses, so it's not necessarily the exact best price series. But most dramatically, the biggest boom ever is this one in the 1990s until 2006 in home prices. New starts went up to a record, almost a record level. And then suddenly the home prices collapsed dramatically. And look what happened to housing starts. Housing starts went down by 80%. And then they recovered dramatically. And so did home prices. So there's something, this is animal spirits driving the economy. I'm calling it animal spirits. It's some idea that people got that home prices always go up.
How would you decide whether a housing market in a particular area or a country or continent is rational or not rational?
Yeah, that's difficult. It's judging people. And it's very hard to predict turning points. When will a bubble burst? So a lot of people would like to give up and not try to do that at all. But I think that's a mistake, too. It's about humans. Humans make big mistakes. If you look at history, there are horrible mistakes that people have made, often unmasked, where millions of people are all thinking the same thing. And it turns out, how can millions of people be wrong? Well, history shows they've done it again and again. Now, one thing that happened, just to try to put it in your mind clearly, why we had a housing bubble, I also asked on my questionnaire your expected 10-year home price appreciation. What do you think houses in your area will do on average in terms of price increase per year for the next 10 years? And so we found that the average, this is actually a trimmed mean, essentially the average response was 12% a year for the next 10 years in 2004. That's what people expected in the United States. That's a pretty high appreciation. given also that they were at almost record high, they had record high levels in 2004. So what did people think? 12% a year, that would double in just like 6 years. But they were already high. Did they really think that? I don't know if they knew what they were saying. But let's just take it. They thought 12% a year. What could you borrow on a mortgage for it? Well, the 30-year mortgage rate was 6%. So does this look like a good deal? You buy a house, you invest, you only put down 5% of the money or less, and you're leveraged 20 to 1, and you have a 6 percentage point spread between between the interest rate you pay and the appreciation you get. Also, the interest is tax deductible, and the appreciation is the capital gains, and you have deferred taxes on that, or maybe never have to pay taxes on it. Pretty good deal, right? If there's a 6 percentage point spread. Roughly speaking, you're leveraged 20 to 1. What rate am I getting per year? Sounds like 120%. I didn't do that carefully, but it was you'd be stupid not to buy a house. Everybody thought that. You got to get into this market. And there weren't enough people saying, hey, wait a minute, maybe this is a bubble. Nobody used the word bubble yet. The term housing bubble, I searched for it in Ngrams or a newspaper. It was used rarely, not common. The word bubble was something you were trained not to use in college when you took your financial markets course. You were told markets are efficient. Maybe they were starting to doubt it after the stock market correction of 2000, but it still hadn't reached most people. So that spread looked pretty good. So what happened? My data back then ended, I guess, in 2012. The spread is gone. People don't expect to make more than they're paying on their mortgage. Even though the Fed has cut interest rates and mortgage rates have gone down, they haven't gone down as fast as expectations have. So lots of people are thinking, you know, I don't need to own a house. You know, I'll live in an apartment. That's fine. It's carefree. I don't have to mow the lawn or worry about anything. Young people are more urban oriented. You live in a city where apartment living is more acceptable. Anyway, why did this turning point happen? Why did everyone seem to believe this and then suddenly not? Well, actually, we usually date the financial crisis as showing its first fault signs in 2007. But I would date it back to 2005. And it seemed that I could see something in the air in 2005, not in the air, in the media, that public attitudes were changing. So The Economist magazine, which is British, but the similar things were happening in Britain, wrote a cover story in June 16, 2005, which showed house prices falling like a brick. And nowhere were they actually falling. This was how The Economist getting out ahead of the game. They're to be congratulated for writing this story, because they, in a sense, predicted the crisis. And this is a line from that story. Perhaps the best evidence that America's house prices have reached dangerous levels is the fact that house buying mania has been plastered on the front of virtually every American newspaper and magazine over the past month. They noticed, they read all the newspapers, and they noticed, suddenly everyone's talking about crazed home buyers. Suddenly it began to look embarrassing. It used to be, it's obvious. You can get this huge advantage by buying a house because home prices always go up. But now there's all these stories saying I'm stupid to have bought the house. It suddenly clarifies people's thinking. It wasn't just The Economist. Here's Time magazine. This was 3 days apart. They came out with a cover story, Home Sweet Home, Why We're Going Gaga Over Real Estate. Will your house make you rich? Super hot markets. Is it time to buy or sell? The case for renting. Wow, and this was a major magazine. They're practically telling you right on the cover that it's crazy. And then I have one more slide. I was interviewed by Barron's magazine. I think this was a cover story. I'm not sure that I remember right. I was interviewed by Barron's because they knew that I'd just come out with my second edition for Irrational Exuberance. And John Lang interviewed me. That's me standing out in my own neighborhood here in New Haven by a home next door. And what it says at the top, economist Robert Shiller, whose book Predicting a Stock Market Rout arrived just before the NASDAQ began its sickening slide in 2000, sees another bubble ready to burst. Home prices, he contends, could fall as much as 50% adjusted for inflation. So I remember the Lang called me up and he said, I'm going to quote you that you think home prices would fall 50%. Are you sure you want to say that? He caught me late at night. And I was thinking, oh my God, am I going to make a prediction like that? So I had like 60 seconds to think about it. And I said, yeah, go with it. Actually, I was wrong. They only fell something in the 40%. It wasn't quite 50%. But it really gave me a sense of the turmoil that was developed. The public tends to be kind of faddish, and they take on ideas that spread by word of mouth. The idea that it's a terrific thing to do to buy a house. It's been happening more recently in other countries like China, where people think, wow, you know, I should buy a house. And even though home prices in China at some points reached very high levels. It's just human nature. It's the same in every country. There's the same vulnerability everywhere.
Do you think there will be a new bubble after 2007 crash in the housing market, especially in some like emerging markets like China?
Oh, yeah.
I noticed that the real estate market has been recently booming in China, especially in the metropolitan cities like Beijing, Shanghai, Shenzhen, and the housing market and the housing values in Shenzhen has grown 10% compared to last year, and amounted to $659 per square foot compared to the Manhattan's 1,495. But I think the average salary is not the half of the Manhattan's. What do you think about? Is there a new bubble?
Yeah, well, China, there are various measures of valuation of real estate in China. So one is price to income. This has been remarked by many Chinese, that they say, how does anyone afford this real estate? Because, you know, look at the average salary of someone working in one of these major cities. It's just, the ratio of price to that is just beyond belief. So how do they afford it? Well, their parents are helping out. They're borrowing what they can, and they think that it's all going to be worth it because they're going to keep going up. So there are other measures. You know, just the rate of appreciation has been high in China. The total value of land in China is high relative to their GDP. So there's a lot, and price to rent is high. When you move to Shanghai or Shenzhen, don't buy, rent, and invest your money somewhere else, maybe. I shouldn't speak with utter confidence about China because I'm not an expert on I have never lived there. But it does seem that China is a special case regarding real estate. One of them is that it's still difficult for Chinese people to invest abroad. There are limits on how much they can put abroad. And so they're stuck in China. Secondly, there's a fear of corruption in China, a fear of being taken advantage of. And I know Xi Jinping is trying to combat corruption, but I think there's still a public perception. So they might tend to prefer investments in a house that they can see. And there's also, people have pointed out in China to the relative shortage of females relative to males. And many parents want their son desperately to get married. So they save all their money and buy a house for the son so that he can impress a young woman that he has a house. These are all kind of peculiarly Chinese factors that has been driving home prices up there. Now the question is, will they stay up there? That's an interesting question. Always the long term comes in. So will these factors continue? Well, they might continue in the short run. But my bet is that China is going to be on the path toward liberalizing so that Chinese people can invest abroad more. I'm guessing. I'm not an expert on this. And things will change. Now, the other thing about China, it's an interesting thing. Its economic growth rate has been so high that you might think it's not going to be very long before Shenzhen, Beijing ought to be the highest priced cities in the world. But then that brings in question, there's a slowdown in China now. Maybe people won't feel quite so optimistic that that's right around the corner. So there might be a slowdown now in Chinese real estate prices. But, you know, these things are hard to predict.
Well, let's say that someone even could recognize that there's these social quirks that we have in terms of the behaviors of maybe the word-of-mouth behaviors that we're hearing in terms of whether you should sell or whether you should buy, for instance. And I'm thinking about the housing crisis.
Yeah.
Now, let's say even you could know as a homeowner before you buy your second home to then rent it out to someone. Let's say that you suspect we're in a quote bubble.
I did that, by the way.
And nonetheless, even if you know if the market is still going, shouldn't you take advantage of that of that bubble?
Now, here's another issue. Yes, when a market is going up rapidly and you think it's because of psychology, you might want to short the market to benefit, own a negative quantity. You can't short houses.
Sure.
So a lot of people during the housing bubble, it's a little bit hard to get out of that market. But a lot of people, I'm sure, did because they think it was going crazy. But the problem is you don't know when it's going to turn. And there's a folklore that it usually takes several years longer than you ever imagined for it to finally turn. And then it finally does. But if you were a short seller, you might go bankrupt before that time is reached. Or if you are a financial advisor advising clients to stay out of the market, you will have lost all of your clients before the turning point comes. This is part of the tension that makes it hard to deal with these phenomena.
Building on top of Olivia's point on like stock price and value, when bubbles exist in the market, like for example in 2000 with the dot-com bubble, how does that affect the ability of stock price to reflect or indicate value?
The term bubble was coined in 1720 at the time of a stock market crash in France. And it's kind of stuck as a colloquial term. It spread to other countries from France. And it was a colloquial term that stays with us. But academics have always had a little trouble with it. What it refers to in my mind is there's an upswing and then there's the bursting. The upswing of the bubble is when stock prices or real estate prices or some other speculative asset goes up as a sort of part of a social epidemic. Where the price goes up, people start talking, they remind themselves of good news, they forget about bad news, and it goes up again. More people start thinking, I should be in there shopping, I should be buying this. And then the price gets really high. Doubters start to appear, saying this is crazy. First of all, nobody believes them, but then the market starts going down, and then they're thinking maybe the doubters are right. And so then they start to bring it further down. Now this, you might call it a theory. It's a theory that people in the news media said was obvious when they were writing reports on it. They could see in the 1720 bubble, you could go out on the street in Paris and you would find mobs of people all shouting and excited when the market was crashing, or even before when it was going up. It looked crazy. Economists, though, who are more academic or more professional, don't naturally take such explanation. So I think the word bubble has had limited impact, except for what they call a rational bubble, which I won't get into. There is a theory about possibly rational bubble. But so economists, just by their nature, they're not psychologists usually. They don't get it. So in fact, though, the 2007 world 2007 to 9 world financial crisis was a time when the word bubble came into more broad use, even among academics. It used to be not in the textbooks of finance. They put it in after that. And now you can actually say bubble without feeling embarrassed.
It's kind of
Here,
interesting.
yeah,
Oh, sorry.
right.
It's kind of interesting how like the term bubble. It seems like assume that it's at some point it has to burst and then everything has to come back down to, I guess, the truer core of what it's supposed to be.
I guess sort of related to that, do you think that there's something about the 2008 crisis that was different that made bubble a more appropriate term than it had been for these previous crashes?
Yeah.
Well, I don't like, your metaphor point is right. The word bubble, coined by somebody 300 some years ago, suggests that it grows, like when you're blowing a bubble with a bubble blower, it's getting bigger and bigger, and as you watch it, you think, it's gonna pop, it's gonna pop, and then poof, it's totally gone, unless you blow up another one. But I don't think bubbles are quite like that, because they don't crash completely. And then you never know, they can come right back up. So I think I would have preferred, if I were back in 1720 naming it, I would call it an epidemic, because epidemics don't just disappear. You know, they grow for a while and then they recede and then they come back again.
I like the idea of epidemic too, because it sort of suggests that it's contagious, right?
Right. Now I think I like epidemiology, which is a course in the medical school, because it also suggests why it is that bubbles appear so mysteriously. It's the same way that, let's say, an influenza epidemic appears. Suddenly hospitals are reporting there's lots of new cases. Do they know why? Well, they'll say maybe the virus mutated and suddenly it's more infectious. It's the same way with stock market bubbles. So suddenly the market goes up. It wouldn't be a virus, we'll call it a story or a theory. And the theories mutate the same way viruses do. Like there's some new news thing or some politician says something and suddenly it's more contagious, a better story that people will tell to influence each other. So it's, I use the word bubble because I think I know what people mean by it, but I think it's really epidemic, that word we want to use. And the 2007, was that different? Another thing that was really unique about 2007 was that we had the biggest real estate boom ever in major countries. Like, notably, the boom was really big in United States, China, UK, Spain, Italy, and it was also in other places, but Iceland, Ireland. It was really big, reflecting something that, why did it get so big? You know what, I think part of the reason is the efficient markets theory itself. Because before then there would be public leaders who would come out and say, this is crazy. But now they didn't want to, because they didn't want to appear unscientific. So science shows that these markets are right, uncannily right. So I'm not going to criticize it. And if nobody criticizes it, it can just go wild. During the efficient markets era of the second half of the 20th century, it was as if there's this smart money out there evaluating the level of the market. But you know what? I never meet this smart money. I only meet people who are trying to predict where it's going in another year, not thinking about these big issues. Maybe there are some, but are they really dominating the market? That's the kind of doubts that came forward after 2007.
Do you think it's irrational for an investor during a bubble to invest in the market, even though you might think it's a bubble, but prices are going up and like?
Right. Oh, yes.
So is it really irrational to invest in a bubble? But
right.
Could you say rational bubble again? What do you?
Right. If you can predict when it will burst, then you would want to go in and ride with it. Now, there are some theorists who've argued that that in fact gives a rational, I mentioned rational bubbles, or there's quasi-rational bubbles where some people are rational and that their behavior exacerbates the bubble. So I think that maybe you do want to ride a bubble. But I think it's a tough business.
So maybe also when you're in a bubble, you might know, like bubbles, you know it's a bubble when they burst, right? Maybe in hindsight you can tell it's a bubble, but while you're in the...
See, one thing people have to realize, after the fact, there's a tendency toward what they call historical determinism. Reading back on history, you imagine you could have seen it all coming, it was obvious. So in the 1930s, for example, didn't people know World War II was coming? It wasn't that obvious. Well, it seems that way to us, but it wasn't at all obvious then. And it's the same true for any of these events.
Just to follow up, how does short selling affect the development of short selling affect the, I guess, rise and fall of these bubbles?
Right. So in the 1970s, Edward Miller, who's a finance professor, wrote a famous article about short selling, saying, you know what? I think this was a major article. It seems so obvious after you read it, but before. Edward Miller said, you know what? This efficient markets hypothesis just can't be right because there's nothing to stop some group of zealots. We know that some people have crazy beliefs, right? Well, there's nothing to stop them from going in and bidding up the price of some stock to some crazy level, and everybody else knows it's crazy. Unless you can short sell, that means borrow shares and sell them, enough so you can offset all of these. But what if all these people buy up all the shares and they hold them personally so that they're not available for shorting? Maybe you can't short sell. So what's to stop it? That was his question. And you know, the finance profession was embarrassed by this because they didn't have an answer. The answer is, if short selling is hard to do, and in some countries, like China, for example, it's been very difficult to short sell. If you can't short sell, there is nothing to stop crazy people from bidding up the price. It's free, markets are free and open. Somebody gets a screwy idea that this stock should be worth 1 million times earnings. If they want to bid it up to that, it's their business, they can do it. That's one reason why. Now in terms of housing market, traditionally the housing market, you can't short a house. You can't say, can I borrow your house and I'll sell it, and then I'll pay you back with a house like it? That doesn't happen. Now, I worked with my colleagues to create a futures market for single-family homes so that there would be, and an options market, so there would be a possibility of shorting. You could buy a put option on a house. And we have that market. The problem with it is that it's not very liquid. I'm hoping that it will eventually, but this is at the Chicago Mercantile Exchange. We have 10 cities traded, and the United States as a whole. And there are also, there are other, like the IPD in London, which does commercial properties. There are ways of shorting real estate or property, but not, they're not huge. And I think that short selling has its own inherent problems. It has to be facilitated by regulators, and it has problems of itself that being a short seller is a risky business. You might go bankrupt trying it. And so it's just limited. And that's an important reason to doubt market efficiency. So today I wanted to talk about crises, misbehavior, and regulation. It's a huge topic, financial regulation. So I wrote a book with George Akerlof called Fishing for Fools. We're using the word phishing more generally than it's usually mean to me, any manipulation or deception. And we coined a new word, fool. Well, actually, it's already a Hindi word, and it's used in India English to mean a flower, I guess, or somebody's name. But for us, fool with a PH is somebody who doesn't appreciate how much he or she is being manipulated. And most people are fools that we want to open their eyes to manipulation. So regulation is substantially aimed at dealing with human problems and with manipulation and deception. We just talked about it, for example, with the mortgage regulation, which is intensive. It has to be detailed because there's so much involved and so many people playing games. They're not all playing games. One theme of our book here is that it's not that people are bad. It's that people are constrained by the market. If everybody else is doing something, you have to do it too, or you won't stay in business if there's some manipulation that works. So for example, when you go to the store, this is a trivial example. You go to the store and look at prices. You'll see something priced at $9.99. Now you think, wait a minute, why don't they just round that to $10? Well, you know why they don't. There's a psychological tendency to just look at the first digit or to count how many digits in the price. You don't want to add another digit and go from $9 to $10. You're playing a trick. It's phishing, as we define it. And why do you do this? You do this because everyone else is doing it. And in a competitive market with narrow profit margins, you can't escape it. You've got to do it too. I remember in my own company, Alan Weiss called me one night, Case Shiller Weiss, and he said, what should we price our online mortgage service? We had an online, I think we were the first to give, we gave price estimates for individual homes. You'd type in your address, and then we would give you an estimated value instantly based on our models. Zillow later came in and took over that business, but we had it for a while. What should we price it? And the question is, should we price it at $29.99 or $30? And we felt in a quandary because you know that business is better if you lower the price a little bit below a pricing point. But we finally decided, no, we don't play that game. We're a firm of integrity, and we priced it at $30. But you know what? We had no competitors. There was nobody else on the web at that time giving you an instant value for your house. So it didn't matter. We did all right, finally. We sold that company, by the way, in 2002, a long time ago. But I remember the doubts we had about playing the game. And some companies stay above it, but you can't do it in a tightly competitive market. You can stay above it, but you'll be thrown out. You'll go out, you won't make any profits, and you'll go out of business. That's what we call the fishing equilibrium. So you need regulation, and our book is a plea for regulation. And when I mentioned that the QRM rule was 689 pages long, I'm not saying it was evil or corrupt. I'm saying they're dealing with a very complex problem and a huge industry with tons of lawyers representing their interest. And I have to hand it to the people in the regulatory agencies. It looks like they came up with a reasonable set of regulations. Now, one thing we have to do is distinguish between microprudential and macroprudential regulation. Actually, these words I haven't looked them up on Ngrams, but I think the word macroprudential is a relatively new word in the last 10 years. Most regulation in the past has been to protect individuals from abuse. But now, after the financial crisis, there's more of that's called microprudential, because it's looking at one guy or one small business. Macroprudential is regulation to help prevent big crises, big events, the macro economy. And it's a revolution in regulation that occurred since the financial crisis. That regulators are not just there to protect you as a stockholder or you as a purchaser of a product. It's to protect the whole economy. Business wants regulation. They might talk as if, when you bring up a specific regulation, there will always be some business people who will oppose it, namely the business people whose interests are harmed by the regulation. But on the other hand, business people want regulation because they don't want to live in a system that forces them to do corrupt things or to do things that obviously are not in the public interest. They would rather compete in an environment that encourages good behavior. Otherwise, they're forced to having the lowest common denominator. It's analogous to sports events, and you have a referee. Do the players want a referee? Sure, they want a referee. They want it to be a good game. They don't want roughhouse. They don't want someone who's going to kill them during the game or risk killing them or give them lifetime injuries. They want a regulator. But of course, when they get regulated, when the referee says you've just committed a foul, they object at that point. But players may have a hate relationship with regulators, but they know that they need regulators, namely referees.
With more regulation, obviously, the key is to lower the risk. But do you think by doing that, is that hindering the entrepreneurs
Right.
At all of companies being able to grow?
Or the smaller ones.
Yeah,
smaller.
there is a trade-off there. I've founded a couple of companies in my life, and I am very aware of the lags that were imposed on us by regulators. But on the other hand, when I met the regulators I thought were impressive people and public-spirited. That was my impression. So I don't know that they're not driving a good balance.
Yeah, shifting back towards the U.S., we've discussed in class about how one of the causes of the financial crisis was that many low credit people were encouraged to buy homes and then they subsequently defaulted when home prices dropped. So what regulations has the Dodd-Frank Act put in place to prevent this from happening again?
Well, the Dodd-Frank Act wanted to get banks responsible for ability to pay and responsible for checking out borrowers. They didn't take their word for it. They shouldn't take their word for it. So there's been a lot of Dodd-Frank set in motion a lot of regulatory rulemaking that is supposed to prevent that thing from happening again. And the rulemaking puts specific requirements on mortgages that are qualified, namely that are QRMs, as they're called in Dodd-Frank lingo, mortgages that are not subject to the 5% retention rule. So basically, mortgages follow the guidelines that were issued in 2014 by regulatory agencies in the United States. And the rules specify that the debt payments, your monthly debt payment, cannot be more than 43% of your monthly income. That's a rule now. What's that?
It's still high, 43%.
That sounds awfully high to me. So you take home a paycheck and you give almost half of it.
Poverty level is 33%. If your housing costs are 33% of your monthly income, it's considered poverty level.
Yeah, well, it's of course it depends on what your income is. If your income is $10 million a year, there's no problem. But and they have to verify that you have a job. They have to verify what your total debt payments are. They have to check on things like you may have alimony payments or other obligations that go into the calculation. So it's going to be harder. That should keep prices more under control. At least you won't be able to borrow to bid these prices up.
What about regulations that might tamper volatility in prices?
Well, this brings me back to China and the U.S. when they put on short sale restrictions that prevented sellers who doubted prices from selling. These things may be important. Maybe government should defend the price of the stock market if it's in a free fall panic. They tend to do that. The problem is that the public starts to expect the government to do that, and then they lose their sense of connection to reality. Especially true in China. There have been there have been big drops in home prices at certain times in China, and the public gets very upset when you bought a house just a year ago or 6 months ago, and now it's selling for less than you paid. So people get angry and they protest to their local government. This has led to some pressure being put on firms to try to keep the price up. And so it leads again to public expectations that prices can never fall. This has been a factor in a number of countries that they think that real estate is just such a fundamental right of citizens that a competent government will never let the price fall. But then that just produces a high equilibrium level price. So it could be that prices will stay high for a long time because of this perception, and there'll be a bad investment. I personally think that for many people, housing, an owner-occupied home is not the greatest investment because it takes up so much of your time and energy to worry about this. You'd be better living in an apartment building and just enjoying life. You can go out to dinner more and you go to entertainment more, not be out there fixing things. And then people imagine that there are benefits. But who knows whether they're right or not? You know, maybe there are neighborhood benefits. Maybe living in a nice neighborhood with friendly neighbors is invaluable.
Tax benefits?
Well, there is a tax subsidy right to home ownership in the United States. And this was, I think, the purpose of creating a tax benefit to home ownership is to encourage home ownership, because it's long been a theory that homeowners are better citizens. In fact, there's even research showing that if you ask people, who is the mayor of your town, more people can answer that who are homeowners than are renters. Surprising, a lot of people don't know those things. So they're more connected. But see, there's a downside to that. So you're connected to your community. You know the mayor, you know somebody else in the government, and you know what the people are doing there. That's good. But the other side of it is you can't be as flexible in taking a new job as you might have been, which might involve your moving. Or just moving a little bit. You know, you take a job on the other side of town, and now you're commuting 45 minutes every day. You'd think, I just moved to the other side of town. It's almost a taste thing, whether home ownership is a great idea or not. I suppose maybe it should be subsidized a little bit. Maybe not as much as it is. Oh, by the way, the other problem with the tax subsidy for home ownership is that it takes the form of a deduction. But most people don't take deductions in the United States because you have to reach a certain threshold before it's worth doing that. There's something called the standard deduction. So especially low-income people often miss even taking their mortgage payment as a deduction. So they don't have the same incentives. It doesn't profit them as much. So it becomes a subsidy for rich people to buy a house. Maybe that's not what we want.
Hinging on the conversation about the Dodd-Frank Act, and comparing that to the implementation of the Sarbanes-Oxley Act to kind of help, usher in an era of internal controls and accountability in firms. What are your thoughts about Dodd-Frank? Did it go far enough, and should bankers and those who administer home loans, should they not be complaining, given the impact that the low income mortgages had on society?
Yeah, well, business people like to complain, especially when it comes to regulators, and I can imagine feeling that way myself. But I think that it's probably a better world after Dodd-Frank. The so-called liar's loans that were prohibited, that was a bad thing, where they weren't checking whether someone even had a job who was taking out a loan. And then they've packaged these mortgages into securities and then just sold them to unsuspecting innocents. So we've made real progress. Could there be more progress? Absolutely. I'm not sure it all comes from legislation. I think it comes from innovation in finance. I think there should be better markets for real estate. In fact, I've tried to start them. I mentioned this in class, that worked with the Chicago Mercantile Exchange to create futures markets for single-family homes. That hasn't taken off. It's there. It's still going after 10 years. But I would like to see it a better market like that. Now, if we had better markets for real estate prices that are liquid and well-defined, so that you had a better idea of what prices levels really are, we might develop new risk management vehicles for homeowners, like home equity insurance, that would insure you against the loss in market value of your home. That would have been a huge benefit in the financial crisis. These are things for the future. One theme I made in this course is that innovation proceeds slowly over decades and centuries. Things like insurance came in very slowly over centuries, over millennia actually, you could define it. These ideas, which seem very clear and sound after the fact, looked very experimental before they happened. So I think that we have to get our mortgage institutions, our risk management institutions sharpened so that they work better to prevent this kind of crisis. This crisis was a mistake. The crisis of 2008, 2009 was a big mistake. But we have to have the right institutions to prevent that from happening again. So I'm going to talk about 5 levels of financial regulation. I'll call it regulation within a firm. That's one. Number 2 is trade groups. These are organizations, voluntary organizations of firms. Then there's local government regulation, national government regulation, and finally international regulation. We've got all of these. So let me start with within firm regulation. The board of directors is a uniform policy, I think, practically everywhere in the world. They typically have outside directors, people from other walks of life, who come in to represent the community or to just give them a sense of perspective. The board of directors hires the president and fires the president if he or she is not acting properly. The board of directors, you can't make their burdens too heavy because you want people who are connected to the world and you value that. So you can't ask them to make it a full-time job. So a board of directors is usually a part-time job. And they're out there and involved in different things. You put people in with reputations. I talked earlier about personality disorders, like the antisocial personality disorders. People who are like that are hard to diagnose, but you can diagnose them. You could get an impression. We're all forming impressions of people's personalities. When you're appointing directors, you don't appoint people who have any shade of suspicion of having a personality disorder. So that's part of what makes directors work. It may not look fair who gets put on the directors, but it's somebody that there's an agreement, relative agreement, is not a criminal, is not a liar, and has some sense of community spirit. So that's how it really does work in most cases. Now, a problem with companies is part of the thing we do. We put people on the corporation or on a board of directors who have such good reputations that they're not going to compromise it, right? If someone says, at Yale College, let's do some devious trick, this guy will say, not on my watch, and will resign, because if you have a reputation, it's precious. So that's partly what prevents devious tricks from being played. Now I want to talk about devious tricks. The word tunneling is often used to describe tricks that people in companies use to steal money from the company. I'm referring particularly to a nice article by Johnson, Laporta, Lopez de Solanas, and Schleifer in 2000. It's an expropriation by minority shareholders or by board members or by officers, as if by an underground tunnel. Now, they conclude in this paper that tunneling is a real and big problem, and it's bigger in civil law countries than in common law countries. Now, what's the difference? Common law is what we have in the United States, which means that we have legislatures making laws, but we also have courts making laws in a different environment. Their laws are not public laws officially, but they're legal precedent. So the courts, when the Supreme Court declares something, it's like making a law. The difference is that, by civil law, as exemplified on much of continental Europe, is entirely legislative. You have a parliament or a Congress that makes laws, and there's no consideration of precedent by the courts. Common law has an advantage in that the courts are making judgments in a specific case where there's a dispute. So that makes them really close to the problem and really close to human issues. When there's a dispute between two sides in a legal case, you hear them on their two sides and you sense there's some emotion here. I can see the conflict. I'm going to try to find a nice way to resolve it, and that becomes law. So I think common law, I'll just say that common law is better than civil law because it has this aspect to it. And it's better able to deal with tunneling, because tunneling comes up in specific cases where somebody has stolen money from a company and the shareholders are furious and they come to you and say this was thievery. But usually it's subtle thievery, it's trickery, and it becomes hard to disentangle. I think the courts do better at disentangling this kind of thing. So Johnson et al. Argue that tunneling is more frequent in civil law countries. Common law is very useful in preventing tunneling and other kinds of abuse. It's something that we don't often see. When you ask why is the UK so successful, it's common law in business, or the US. It has something to do with this. So how do you achieve tunneling? So, okay, suppose you are in control of a company. You're on the board of directors, or you're a major stockholder who can pack the board of directors with cronies, or you might be a CEO who's not being watched carefully by the board of directors. But let's just say generally you have a major ownership in the company. You might own a good fraction of the shares. What do you do to steal from the company? You've got to disguise it. You've got to disguise it in business complexities so that when somebody sues you, it gets all into a quagmire that they can't figure out. What did you do? So one thing you do is you sell assets of the company at a below market price to some crony of yours. So you have a factory that you're not using anymore, and you just sell the building. But you don't take bids on it. You just sell it. You'll say, you have some excuse why you didn't. You say, I don't know what it is. This is my business partner. We have a trusting relationship. I sold it to him, but maybe for 20% of its market value. And then later he'll do me a favor too. But I can't take the money right now because then I would look like I'm a thief, all right? So will the shareholders ever figure out that you just did this? You see that you've taken value out of the company. They've got to figure out what that factory is worth. How do they know? They're just shareholders. So they can't see it. So you do this. Obviously, you do this if you're only slightly corrupt and very loyal to your friends. Also, you can make contracts with other companies and pay way too much for the service. Now, so you sign a contract with your friend's company, your brother-in-law, maybe it's family, and you pay 3 times the market price for that service. So then the shareholders might find out and call up and complain. And so, all right, here's what you do. You make the contract 1,000 pages long. They can't even read it. It's got so many ins and outs. How do they know? How can they know that you're paying too much? Also, excessive executive compensation. This appears to be a problem, especially in the United States. You get people to write letters saying that our new president is this genius, business genius, and maybe some people believe that, but you pay this guy $50 million a year. Loan guarantees typically occur in intercorporation loans. So my corporation will lend money to another corporation or guarantee someone else's loan to the other corporation. And it's all hid behind a corporate veil, one corporation loaning to another corporation. Who's going to figure it out? But in fact, the other corporation is just my crony, my friend. And I'm making a loan. I know he's not going to pay it back. He's going to tunnel it out of his company. And also, expropriation of corporate opportunities. So a corporation has been developing expertise and technology in a certain line of business. The way progress occurs in corporations typically is that some slightly different business suddenly appears that you only know about because you're in the business, and so you can jump on it. But instead of jumping on it, you, the CEO, you get your friend to do it, and you teach him all the secrets of your own corporation, and then he takes the great business opportunity. You can also do dilutive share issues, that issue a lot of shares and then tunnel the money out some other way, and the stockholders are hurt without even seeing it. And insider trading, you can announce news about the company that's good after you bought extra shares, and then sell your shares before you announce bad news. So all these are forms of tunneling. Directors have a duty to prevent tunneling. In U.S. law, when you finally are called by the Yale College Corporation to ask to serve on the corporation, you have to know, I'm telling you now, you have a duty of care. And that means to act as a reasonable, prudent, or rational person would. You can't neglect your duties as a member of the board. And you have a duty of loyalty. That means preventing insiders from benefiting at the expense of shareholders. You have to be loyal to the shareholders. That's your constituent. You are that wouldn't be true of Yale. There are no shareholders, but for other companies. And you have to avoid self-dealing transactions. So here, loyalty is not just a moral principle, it's a legal principle. That's what you are supposed to do as a director. Here's an example of tunneling from France, where tunneling is, according to Johnson et al., much more common than in the United States. So a French company, SARL Perronnet, is a French company owned by the Perronnet family. It leases a warehouse from the Perronnet family at a high price. This is a true case. Minority shareholders sued, saying this was tunneling. The French court ruled that the transaction had a legitimate business purpose and that it was beyond the court to judge whether the price was too high. So they refused to take the case. That means the tunneling was successful. Now, it is difficult for a court to take such a case because then the judge has to get involved in judging whether the price was right. And in France, they don't think they can do that. But in the US or the UK, it would have been a factor. So I think this accounts for the bigger success of stock markets in the US and the UK.
So I guess the banks argue that this regulation of risk destroys their ability to do their job, which is to take on risk, I guess. Right. How do you weigh the two against each other?
Well, this is an ongoing, complicated issue. There are complaints that there are too many regulations and too many forms to file, that it's costly. Just compliance is costly. There are complaints that sometimes the regulations kick in when the company is above a certain size. So that means that companies never want to rise above that size because they don't want to deal with all these regulations. And that sounds harmful as well. I think it's a matter of case-by-case basis. The regulators have to appreciate that too many regulations will gum up the whole system. and make people despair of doing anything. Also, there is sometimes a problem with corrupt regulators. They have to be bribed, and that's a bad situation. So I think that the important thing for regulation is to create an environment for regulators which is conducive toward their having the real spirit of doing good for society. We are professionals. We're trying to do good for everyone. And not to be bureaucratic or insensitive to the costs they're imposing on others. With that, I think regulators can be a huge benefit to our, and they're really necessary for a modern economy. Trade groups is another example. One example of a trade group is the stock exchange. The first stock exchange in the United States, not the first in the world, was founded in 1792, and they signed an agreement, which is still, I'll show you, that's the actual agreement. We, the subscribers, brokers for the, I can't read it too easily, read it here, for the purchase and sale of public stock, do hereby solemnly promise and pledge ourselves to each other that we will not buy or sell from this day for any person whatsoever any kind of public stock at a less rate than 1/4% commission on the specie value, and that we will give preference to each other in our negotiations. So what does, that's all it says. Basically, it's a price-fixing agreement. It sounds like fishing to me. They don't want to compete with each other, and in order to prevent someone undercutting them, they also promise not to trade with any other broker that doesn't sign this agreement. Now, the New York Stock Exchange website has this summary of the agreement. At the heart of the Buttonwood Agreement was the need for fairness, responsibility, and trust. Wait a minute. We just read the whole agreement. It's not there. Maybe at the heart. They say at the heart. So in their hearts, the people who signed the Buttonwood Agreement thought that they were helping deal with fairness, responsibility, and trust. But basically, it's trust that you won't charge a lower price than I am. So it's collusion, as we'd call it. But this sounds to me a little bit whitewashing it. They mentioned William Duer, a former Assistant Secretary of the Treasury, had defaulted on his debt, causing a brief panic in the New York financial market. That was the crash of 1792. The first big stock market crash in the United States. So the importance of being able to trust those with whom you deal. William Duer was a man of questionable ethics who borrowed heavily to buy into the stock market bubble, deceiving others and manipulating. He was a controversial guy. He was one of the rich men of the time, and he did things like have liveried servants. He had his servants like a small army, and they wore military uniforms. This is un-American. Not many people do. The butler comes, he's wearing a tuxedo, right? But there's an older European that you have all of them wearing uniforms, as if you had a private army. He almost got tarred and feathered in 1792. That's what they used to do with controversial figures. The New York Stock Exchange was a monopoly. It was enforcing commission. The commission is what you pay for the service of having your shares sold or for being able to buy a share through a broker. In the United States finally outlawed fixed commissions. It took until 1975, long after 1792. Oh, by the way, Yale College people were involved. President Ford, Ray Garrett, and were involved in doing this. The Big Bang of London was a similar thing under Margaret Thatcher, abolished fixed commissions to eliminate the elitist old boys network. By the way, the Deutsche Börse, they're still trying to combine into a bigger group. The Deutsche Börse, which is the German stock exchange, attempted to buy the New York Stock Exchange and NASDAQ as well, but failed. But the Intercontinental Exchange, ICE, bought New York Stock Exchange. Now the Deutsche Börse is trying to buy the London Stock Exchange. It's all this effort to combine, and But they don't have fixed commission, so it has a lesser impact. I'll focus mainly on the United States. So the United States started out as a confederation of individual states, and financial regulation was mostly a local, if I'm calling a state, a local government. We had two banks of the United States, one created in the 1790s called the Bank of the United States. It was a central bank of sorts, but it didn't conduct monetary policy. But it expired, according to the original legislation, after 20 years. And they renewed it in 1816 with what was called the Second Bank of the United States, which also had a 20-year charter, and it expired in 1836. And after that, there was really no central government regulation of financial activities until the National Banking Act of 1863 under President Lincoln during the Civil War, which created a system of national banks that were regulated by the federal government instead of the state government. So a lot of cities then started setting up, starting right after the legislation, with national banks that had a national bank charter, so they weren't regulated by the local state government. And some of them listed their name as First National Bank of whatever city, meaning they were created right after the act. But even so, then still most of the regulation was in the state governments. The big change came in 1934 when the federal government set up the Securities and Exchange Commission. At this point, the securities law passed substantially to the central government. There has been a trend towards centralization. However, corporate law is still held by the state governments. It was partly inspired by the observation that there was a lot of shenanigans being played in the financial sector. Louis Brandeis wrote a book called Other People's Money in 1914 that argued for more regulation of financial activities. There was, before the Securities and Exchange Commission, there was some expansion of regulation in what was called the progressive era in the United States. That was the first 20 years or so of the 20th century. And a lot of states created what were called blue sky laws, which were laws regulating tricks and deception in the financial markets. There was a lot of fraud and deception in the 1920s, brought on perhaps by the telephone, which made it possible for people to make cold calls with financial deals offered to the general public. And they could easily get away because the person never met the person on the other side of the phone call. The blue sky laws, the first one was in Kansas in 1911, and it became a model for other states. They virtually all established blue sky laws, which typically required the registration and regulated the offering and sale of securities.
Where's the limit? Can there be too much regulation? If we look, for example, in the case of China, right? Like, would you say there's too much regulation sometimes, and where do you strike the good balance, right, between?
Well, my guess would be that China does not have too much regulation, that they are still a developing or an emerging country, and they do have a problem with corruption, as the Chinese will tell you. Their opinion polls there list that as a high problem for the country. So they have a need for regulators to, and President Xi has also launched an anti-corruption campaign. But I think this still has a place to go. It's part of the development of a country that regulation becomes more thoroughgoing, and that in the stages of growth of a country, corruption is an early stage phenomenon that declines through time. In the United States, in the 19th century, corruption was much more widespread than it is now. It's something that is gradually taken care of. It takes resources to do proper regulation and enforcement of anti-corruption laws. And an early emerging country doesn't have those resources. But as time goes on, it develops those resources, and it encourages a culture which itself is inimical to corruption. After the sense that you can't regulate financial activities at the local government level because they spread across state borders, the Securities and Exchange Commission was set up in 1934. It was highly opposed by many people in the business community, thinking that it was usurpation of powers. The Constitution grants to the states anything not enumerated in the Constitution as federal, and the Constitution doesn't mention financial regulation. But somehow they passed the Supreme Court as constitutional. The idea of a Securities and Exchange Commission is an essential U.S. invention. The critical thing is that the Securities and Exchange Commission, following Louis Brandeis, emphasized disclosure. So Louis Brandeis said in that book that if you force people to be seen, if you force people to come out with all the details of what they're doing, that will expose manipulations and frauds. So his famous quote is, "Sunshine is the best disinfectant." I don't know if that's true in medicine, but it's true in finance. So the idea of the Securities and Exchange Commission was to require securities issuers to submit standardized forms about what they're doing, statements about what they're doing, and public corporations to put up for public view balance sheets and profit and loss statements regularly. And Louis Brandeis said it's not enough that they file them in Washington, D.C. They have to be there for people to see. Otherwise, it's not real. It has to be easy for people to come and see these things. Well, the way we do it now is on the internet. So the Securities and Exchange Commission website, sec.gov, you get on their website and you look for EDGAR. EDGAR is the name of their program that dispenses financial statements. And you can get financial statements that were reported by law to the SEC for all public corporations and even for others to a certain extent. William O. Douglas was a Yale Law School professor who at that time was a leader in what was called the legal realist movement. It's something like the behavioral economics revolution that came much later. But this was a revolution in law schools. And as we know from Gillian Tett, different divisions of a university don't speak to each other generally. That's what she calls the silo effect. So this was a law school movement, which I think enhanced the law enormously, recognizing human limitations, that there was too much of putting in legal documents things in the fine print that nobody is going to figure out. So the idea is that you have to force companies or financial institutions to put it out in a clear and consistent, standardized way. So that was partly his doing as well as Louis Brandeis. So he actually replaced Brandeis on the Supreme Court when Brandeis retired. He wrote a book in 1940 called Democracy and Finance about his adventures on as chair of the Securities and Exchange Commission. And it is an adventure because you have a lot of devious people trying to play games with you. Arthur Levitt was another chair of the Securities and Exchange Commission who, after he retired, wrote a book called Take on the Street, meaning Wall Street. It was sort of like up against the wall on the street type thinking. He had a tough time as SEC commissioner because his effort to police what he thought was clear wrongdoing led to attacks on him. Congressmen would call him up who had been bribed essentially by some financial interest, would call him up and try to threaten him. Not mafia type threatening, but some sort of government regulation threatening. So one thing that happened in regulation was some of the regulation was captured. The regulators until 1975 allowed stock exchanges to fix commissions that brokers would charge. I talked about this last time with the original Buttonwood Agreement for the New York Stock Exchange, which was signed outdoors underneath the Buttonwood tree and became known as the Buttonwood Agreement. These guys all were into fixing commissions to make a good amount of money, but that was anti-competitive. A major thing that the SEC did was to define the distinction between public and private securities. Public securities are securities that the SEC has approved for general public investment. And it had to go through an approval process through the SEC. If you want to be listed, your company's shares to be listed on the stock exchange, you have to get approved. You have to make the appropriate filings and get approval as a public company on the SEC. And then you can go, then you have to make these quarterly filings that appear on the Edgar database. An initial public offering is the procedure of going public, okay? It means all companies, I guess, start as private companies, but there's a point in the life of a company when they do an IPO, which means they issue stock to the public, whether or not on an exchange. And the SEC has an announced procedure for going public. Companies can also go private. That is, a public company may not want to stay public. Why wouldn't they? Well, it may be because they have secrets. They feel that having their stock traded in the public domain requires filing all these statements, and they may feel that their business is threatened by that. For example, it's easier for someone to take them over if they're a public company. And they may think that I don't want this roller coaster ride of all of our secrets out there. We have a good company, we're a family, maybe even a family-owned company. We don't want that. So sometimes companies are taken private through a procedure, again, which the SEC recognizes. Hedge funds are examples of companies that are private. Moreover, they are for wealthy investors only. You have to circumvent the SEC rulings as an investment company if you want to do certain things like charge high commissions or high salaries for your leaders. So there are different kinds of hedge funds. One of those are called 3C1s. A 3C1 that refers to some line in the SEC regulations, is a kind of investment company that the SEC requires takes no more than 99 investors. And all of the investors have to be accredited investors. I mentioned this before, but it means income of $200,000 a year or investable assets of $1 million a year. Now, they've left it at this level a long time. I don't remember when it received this definition, but it was decades ago. So $1 million was worth a lot more than it is today. And now, you know, it's not that uncommon to have $1 million. This investable assets doesn't include your home, but the median home price is up to something like $300,000. If you live in a nice neighborhood, it wouldn't be hard for your home to be worth $1 million. It's just now, $1 million isn't what it used to be because the price level has gone up something like 20 times in recent decades. So the SEC proposed in 2006 to raise the $1 million to $2.5 million. And they got they always do these things this way. They raise proposals and they put them up on their website and they invite comment. They got an awful lot of negative comment. People were saying, You know, it's hard enough for us to invest in hedge funds anyway. I've got to have $1 million besides my house. You may say that's not much money, but it seems like a lot of money to me. So they didn't change it. So it's still only $1 million that gets you into this. So you have to go to your broker and prove to the broker that you have $1 million, or your income is $200,000. And then you can invest in 3C1. But no more than 99 people can invest. It has to be under 100. So it kind of limits them. Again, this is to protect the small investor. So that's the motivation, who can't afford financial advice. But there's another kind of hedge fund called a 3C7 that can take 500 investors, but there's another standard for that as a qualified purchaser with a net worth of at least $5 million, or institutions with net worth of at least $25 million. The law wants to protect not just poor individuals, but also poor institutions, like a church or something. They might have $20 million, but the SEC thinks that's not enough for you to participate in this hedge fund. You've got to get more contributions before you reach the level. So the SEC rules that every broker must register with the Securities Exchange Commission. Every stock exchange must register. Every security issue must be registered. Now, the registration doesn't mean approval, although it's some form of approval, but it's not guaranteeing that this is a good investment or anything at all like that. It's just that they've kept by the rules that satisfy Louis Brandeis instructions about disclosure, so that it's just all out there.
There is a concern, though, on Wall Street that a lot of these people that create this legislation don't have any real experience in this world. So do you think that sometimes they take it too far, or more importantly, they don't truly understand the dynamics of the Wall Street environment?
Well, I'm sure there are times when they take it too far. And I've had my own experience with regulators, and I don't know, although I'm an academic, I don't know that they always have an enlightened view. I remember, for example, in 1996, I wrote a paper advocating indexed bonds. So I talked to people in the US government saying we should see inflation indexed bonds issued by the government. And I thought that they were intelligent people that I spoke with, but I thought that maybe they were being awfully slow to adopt to an important new idea. Why was that? I think it's difficult for them to innovate as regulators. They maybe need more public discussion to support it. They end up being, as I said, rules-based. So that means that they might be skeptical of new things. Like, they're not that complicated or that new, but the person I talked to, actually, he wasn't a regulator, he was in Treasury, but I'm thinking of government mentality. He joked with me when I talked to him on the phone in 1996. He said, if the US ever issues inflation index bonds, we'll be sure, this is a joke, he said, around Treasury, we'll be sure to send the prospectus to the members of the American Economic Association, because they will want them. Nobody else will want them. Well, it turns out he was wrong, and we now have a substantial number of US government inflation index bonds. But I think innovation requires a spirit of innovation. I think it's really, I think it is there amongst our regulators, but I think that the government has to make the career as regulator attractive enough that it brings in people who are motivated. In order to understand business, what you may be saying, they have to be motivated a bit like an entrepreneur. They have to have the sense of excitement that something new, but they're not, but they can share in the excitement, but they're not making money off of it. They're a salaried employee. And I think it's possible to get excited about an innovation that you are involved in as a regulator. I thought I actually saw this somewhat. But in order to make that happen, we have to have a government that supports regulators. It should be a career that young people aspire to, not as a revolving door, stepstone to a private job, but as a real career. Now, by the way, the revolving door going as a regulator to the private sector is not all bad either, or the other way, because that's how people develop their sense of professionalism. And it's good if a regulator had worked in the private sector or go the other way. But I do think it's also important that regulators have a sense of career as a regulator, that I don't do this as a stepping stone to something else. I'm doing this because it's interesting and valuable to society. So as a student here, you have a sense of idealism in what you, you do, I hope. Are you thinking of becoming a regulator?
Personally, no, but...
Nobody here is thinking of becoming... Well, I want to put that thought into your minds if I can. Okay, insiders versus outsiders is another SEC concept. So insiders are people with special knowledge because of connections about a company. Inside information represents wealth. If you know something that the general investing public doesn't know, that's an opportunity for you to trade on that information. So the SEC wants to block that. They want to block insider trading. So amongst the things that the SEC has done is issue regulations about disclosure, like Regulation FD, which they issued in 2000. Regulation FD came long after Louis Brandeis. They had telephones when Brandeis wrote, but they didn't have the internet. And they didn't have the kind of access that's now possible. So Regulation FD requires that when a company tells any material fact to an analyst, it must be also immediately told to the general public. So typically companies will have open analysts discussion where you can log in and listen to the discussion with the analysts. But some countries really haven't had insider trading laws. Germany did not have them at all until 1994. Some people, like Hein Leland, have argued that insider trading is good. Why don't we just let it go? And the insider traders will compete against each other, and maybe they won't make so many profits after all, and everything will leak out and everything will be known. But the general opinion is that it's not a good thing. You don't want people who are in a company trading on company secrets. That just doesn't sound right. And it discourages people from investing if they think they're being disadvantaged by insiders. So the SEC has asked companies that are and stock exchanges to help them to try to find insider trading. So the stock exchanges have sophisticated computerized systems and self-regulation. SROs are self-regulatory organizations that follow the SEC directive to themselves regulate against insider trading. So I'll give you an example of insider trading. In 1995, a secretary at IBM Corporation was asked to Xerox some documents related to a secret plan to take over Lotus Corporation. Lotus Corporation was I guess the first major spreadsheet company. Now it's been taken over. It's no longer important. But anyway, she told her husband, who was a beeper salesman. They used to have beepers. You don't need those anymore with your cell phone, but it was something in your pocket that would beep and warn you when information was just coming, and you could find out what it is. This was on, okay, by June 2, he told 2 friends who immediately bought. By June 5, 25 people spent. It's only $500,000, not a whole lot. But these were a pizza chef, an electrical engineer, a bank executive, a dairy wholesaler, a school teacher, and 4 stockbrokers. They figured it all out by subpoenaing telephone records and questioning people. They traced through the whole scheme, and they were penalized for doing it. You're not supposed to do this. So if someone tells you, my wife works at such and such a company, and she was Xeroxing something, and they're going to have a big deal in 3 days, you don't go out and buy on that, because you know you are trading on insider information, and that's illegal. I'll give another example. Emulex Corporation. Mark Jacobs was an employee at Emulex, and I don't know what happened. He quit or he was fired. And so he got kind of miffed, and so he shorted the stock of Emulex Corporation. So he held a negative amount of it. He was hoping it would go bad. But, you know, as a short seller, it might go well, in which case you lose. So he thought, I have to generate bad news about Emulex Corporation. And he could do that because he was formerly an employee of Emulex Corporation. He knew how they act. So he sent out a fake news release to the, on the internet, and it was picked up by these very susceptible news stories, news agencies who don't check. It looked like it came from Emulex Corporation. So he then sold his stock in Emulex, or he covered his short in Emulex right after. That means to cover your short means you buy the shares back at a low price, so that cancels your short. So they had to figure out who did it. Now, he thought he was being very clever. He didn't use his own internet. He went to a public internet service at El Camino Community College Library. And he thought, I'm perfectly safe. They can't trace this to me, but he was wrong. They did. They went to the El Camino Community College Library and showed the librarians photographs. Do you remember this guy? And they did. So he was caught. So that's insider trading. Another crime of financial markets is something called front running. So when you place a large order with your stockbroker, let's say you want to buy a lot of shares in some company. Well, if you're going to buy a lot of shares, it will affect the market price. Say it's a really big order, you know, millions of shares. It's big news if you tell your broker, I want to buy this, and please do it. So the broker then has some time and discretion about exactly when to, he tries to find a good price for you. But meanwhile, your broker could trade on his or her own account, or tell some other broker, I'm going to put in a big order now. You might want to buy ahead of the order. So the other person can buy at the still low price and sell it, an hour later at a much higher price. That doesn't sound right, does it? That's called front running. It's also illegal. Decimalization it has been claimed to favor front running. It used to be until 2001 that stock exchanges quoted prices of stocks in 1/16ths of a dollar. They moved to pennies. It seems unnatural to be quoting prices in $60 and 1/16ths of a dollar, or at other times eighths. But they moved to doing it in the way that seems natural in 2001. It makes it a little bit more possible to squeeze in between, suppose the stock is selling for $30 a share, and then you think after the order it will be selling at $30.05 a share. That's if shares are traded in 1/16ths, that's a narrow window. But if it's traded in pennies, you can get between those two prices. So accounting standards is another thing that the SEC is involved with. It has the statutory right to establish how the company's accounts are done. But it doesn't want to do it. It doesn't want to be the maker of all standards in business. So in 1973, the Securities and Exchange Commission officially recognized an organization called the Financial Accounting Standards Board in Norwalk, Connecticut, as a authoritative for accounting standards. But FASB, as it's said, is not a government agency. It's, I guess it's a nonprofit created by the business community. The FASB defines what are called generally accepted accounting principles, or GAAP. We talk about GAAP earnings or GAAP other concepts. So GAAP defines a concept called net income, which is the bottom line, the earnings of a company, and it also defines something called operating income, which is a narrower concept of earnings. It equals revenue minus cost of doing business. GAAP would also take off charges for special events. Say they lost money through a hurricane or a financial crisis, and they think it's not really reflective of our business because we're doing our business as normal, and then something totally out of the blue came. So it should be, according to GAAP, according to FASB concepts, it should be considered, the event should be considered part of net income, but let's provide also to investors operating income, which gives them a sense of what's happening here with this business. There are lots of other concepts like core earnings, pro forma earnings, EBITDA, which is earnings before interest, earnings before interest, taxes, depreciation, and amortization, and adjusted earnings. But these are not GAAP. They're not GAAP because they're not defined by FASB. If you go to the FASB website, you'll get totally confused because there's so many disputes about earnings definitions, and they have to decide amongst them. So I wanted to tell you about insurance of corporate accounts. We have the SIPC, which I'll come to in a minute, which was created in response to failures of brokerage firms. So Goodbody and Company in 1970 was a brokerage firm which failed in 1970. It went bankrupt. Now, what does a brokerage firm do? Well, there are members of that firm are stockbrokers. You have to call a stockbroker. They didn't have online brokerage back then. You would get on the phone. Someone would say, if you want to buy shares, you'd say, who is a good broker? And your friends would tell you, call so-and-so at Goodbody. And then you would call this person and say, I'd like to buy 100 shares of Ford Motor Company stock. And the guy would say, well, would execute the order for you on the floor of the New York Stock Exchange. And then you would own the shares. Then the broker would send you a statement and show you how many shares you own. But the funny thing is that the standard was that the shares, unless you asked for the certificates, you could say, I want the certificates mailed to me. And then the broker would tell you, well, I can do that, but do you really want to worry about those? You know, I can just hold them for you. And then it's easier when you want to sell them. You don't have to mail them back to me and all that. So then most people said, okay, fine. That meant that the shares were held by the brokerage service on your behalf. And they were sold, actually, as far as the company knew, they didn't even know that you existed. You were now a shareholder in the company until the brokerage service reports your name to the company. They're just held in what's called street name. So the Goodbody and Company is the official owner of the security, although they're operating on your behalf as a stockholder. So what happened when Goodbody went bankrupt? This was a big issue because it could threaten the public confidence in the whole brokerage system. The financial community, Merrill Lynch took over Goodbody. New York Stock Exchange pledged $30 million to cover losses. And in fact, none of Goodbody's retail customers lost anything. But it wasn't because of the government. It was because the financial community had some sense of integrity. And what was happening with Goodbody? They weren't running the business right. And so, yeah, they held your shares, but they were doing something else. And they just got wiped out. But nobody lost. But it led then to thinking that we have to do something. So Senator Ed Muskie took that example of Goodbody and Company to think that we need something like deposit insurance for shareholders in securities. If we're going to have things held in street name, it's just like a bank. You know, you have to trust them that they really have the shares for you. So they created a public insurance, well, it's like the FDIC, the Federal Deposit Insurance Corporation. The SIPC is Securities Investor Protection Corporation. And like the FDIC, it has limits on how much they'll support you for. So the current limit is $500,000 per account. And also they separately, you might also have a cash account at your stockbroker that you would deposit in the, you could write a check to your broker for $100,000 and say, we're going to think about what I'll invest it in. You hold the $100,000 for me. Well, that kind of account is only limited to $100,000. So there have been a lot of complaints about SIPC. The SIPC has been very worried about, over the years, has been very worried about its own integrity. It is on its own feet as a corporation that would probably be bailed out by the government if it failed. But so it disallows claims that aren't filed properly, claims against bad behavior of your stockbroker. And it doesn't cover everything. And it's also extremely slow to pay. Nonetheless, it's a positive thing. The 2008 financial crisis, a lot of our regulation is always a reaction to crises. So we've talked about the 2008 crisis. So in the 2008 crisis, it was substantially a mortgage crisis. Banks led to homeowners on their mortgages, on their homes, to buy the home. And it became a period, as we've talked about, of high leverage. Banks were allowing homeowners to borrow a lot against their home. And banks often concealed their liabilities in what's called off-balance sheet accounting, which needed to be regulated more. Home appraisers were, in effect, bribed by mortgage lenders. Well, it wasn't a literal bribe where they would hand you a suitcase full of $100 bills. It was simple, very simple. When you take out a mortgage, okay, part of due diligence in approving a mortgage is to find out, is that house really worth what you paid for it? Because you could be playing tricks on the broker. You might have paid too much for a house. The other side of the transaction was your crony is going to pocket the money. So you have a sales certificate for a lot of money, but it's phony. So in order to protect against that, banks have to hire someone to go look at the house and appraise it, give an independent guess what the house is worth. Unfortunately, some of the banks would tell the appraiser what the sale price was, and then the appraiser would come back with a value slightly above that all the time. So you'd think that the bank would catch on to that. This guy's a sleazy appraiser. There has to be some times when he disagrees with the purchase price. If he's constantly coming out with an appraisal just a little bit above the purchase price, this guy is a phony, right? I mean, there has to be some instance. But banks didn't care. That's partly because that was before the 5% retention rule and qualified residential mortgage regulation. So they just didn't care. And in fact, some brokers, which were the more reliable and higher integrity, who didn't play that game, they just wouldn't get called back by the bank anymore. The bank just wanted to see it approved. It became cynical. There are other examples I give here, like rating shopping. Banks who are issuing mortgages or other mortgage originators would call the ratings services, Moody's and S&P and Fitch and others, and they would say, we're thinking of floating this kind of security. Can you give us any indication what the rating would be before we send it to you and have you officially rate it? And if the rating agency gave it on the phone a bad rating, they'd say, okay, I think we'll rethink that. We'll talk to you later. And they never call them back. That's called rating shopping. So if you have a number of raters, and you only submit your securities to be rated to the one that told you on the phone they'd give it a good rating, then something's wrong. So Dodd-Frank Act created the Financial Stability Oversight Council, which is the FSOC, which is headed by a number of regulatory agent heads, which is supposed to look at all these problems that might lead to another crisis. And it also created the Bureau of Consumer Financial Protection, CFPB, usually Consumer Financial Protection Bureau, CFPB.gov. That was Elizabeth Warren's idea, who is now a U.S. Senator. Similar things happened in Europe, again in response to the financial crisis. The European Systemic Risk Board, the European Banking Authority, European Securities Market Authority, and European Insurance and Occupational Pension Authority. They spread them out over different cities. That's the European Union style.
So how do you think they can actually balance the innovation of the financial institutions while also try to risk management?
Right. Now here is a problem. The government agencies tend to become bureaucratic, and they assign specialized functions to different people. So what tends to happen is they have rules with numbers, and they have different kinds of vehicles with numbers and letters associated with them. And you come into this maze of rules that they themselves can't even change overnight. You have to, if you want to appeal to changing some basic rule that they have, they're going to have to put it out for comment. They're going to have, and they'll get 10,000 comments. It becomes hard for any individual, even a well-meaning regulator, to do the right thing. These are just occupational hazards. So they, but the regulators that I have met, I've been impressed, as I think many people are attracted to the job as regulator. You might think, why would anyone want to do that? Well, I can see why one wants to do it, because one's interested in, let's say, finance, if it's a financial regulator, and one is a well-meaning person. Isn't it an interesting job to be trying to get the system to work well? Now, some people say, I'm naive to suspect that anyone would be interested in doing that. But I kind of feel that I know that they are, because I've met these people. And it seems like it's a good thing to do. And not everyone is motivated the same way. And so I think that this is something that's not mentioned enough in finance discussions, that we do really have well-meaning people who are confronted with a system that may not always function well for them to feel good about what they're doing, and so they want to fix it. And finally, I wanted to get to international regulation. One of the most venerable international regulators, I don't know if it's really a regulator, it's like a banker's bank. The Bank for International Settlements was set up in 1930, which was a central bank for central bankers. At that time, in 1930, there was some tension, international tension, that led them to think that central banks didn't want to deal directly with each other. They wanted an intermediary so that they didn't have public. This became more important later when the Nazi government appeared in Germany. And well, even by 1930 with Mussolini in Italy, they wanted to deal with them, but they didn't want to deal with them directly. So the BIS was set up. Now it has 57 member central banks who are in turn national regulators. And it's located in Basel, Switzerland, which is a charming little town in the mountains in Switzerland. Far away from any international intrigue. And Switzerland, of course, is a country that's been neutral for since time immemorial. So they tend to set up things like this in Switzerland. Separate from that is something called the Basel Committee. In 1974 was set up to coordinate banking regulation. In 1988, they set up Basel I, which was their first statement about proposed banking regulations for countries. They didn't have any authority to impose these regulations, but they recommended them, and most countries of the world took them on. It was revised in 2004 as Basel II, and it was revised again in 2009 after the financial crisis with Basel III, which was adopted by the G20 countries in 2010. The G20 countries, I'll come back to that. Here we are. There are these different international organizations which have no official regulatory power, but they are meeting places where governments of countries get together and discuss regulatory issues. And they make statements at the end of each meeting which often lead to parallel regulatory changes across countries. So the G8, they started out as the G6, I guess, and then they were the G7, and then they're G8. And now they're G7 again because they kicked Russia out, at least temporarily. So these countries, they typically have two separate meetings, one for the finance ministers and one for the heads of state. The meetings of the heads of state get the most attention. Then there's the G20, which is more comprehensive. Now it's 20 countries. I've got them listed here. They haven't kicked Russia out of this one. The G20 is less collegial. It's everybody. It's really all the big countries in the world, and there's some tension among these countries. So if you look at the G7 countries, they're all kind of, well, I can't seem to go back. They're all sort of Europe and Japan, and US and Canada. You wouldn't expect big disagreements among these countries now. But the G20 is more, I've talked to people who attended both of them and claiming that the G20 is more countries reading statements that were written by their propaganda experts. And, but they function well. One thing they did is approve the Basel III agreements. Their next meeting is in Hangzhou in China. Financial Stability Board is another thing that was created by the G20. Actually, it was a reconstitution of something earlier called, in Basel also, called the Financial Stability Forum. The Financial Stability Board makes, or FSB, makes proposals about financial regulations to the G20, which often tend to be adopted in many countries. So those are, we have international financial regulatory organizations which in effect set policy, but we don't have international regulation, which is becoming a problem because we have more and more multinational firms that operate across national borders, where you as an employee don't quite know what country you live in because they might transfer you to another country any day now, and your corporate offices are in some other country. I think this will grow and grow through time as the economy gets more developed. So we'll need more and more international regulation. But it's a theme. I go back to, I assigned as a reading for this part of the course the introduction to my book with George Akerlof called Fishing for Fools. And again, the basic thing that we want to get across is that regulation has always been the secret to success of free markets. That is, the markets have to be regulated within limits. In the United States, after the Great Depression, before World War II, the reaction to the complaints about the financial community by the Franklin Roosevelt administration was to let's make capitalism work by regulation. The reaction in other countries wasn't quite the same, but I think it led to relative success of the US economy. And the SEC is now copied by other countries widely, the general concepts of regulation. So I think it is to set up free markets, unregulated free markets as an ideal, is just being ignorant of history. These markets have generally been regulated by the state governments in the United States or the federal government and in other countries. They've never been left completely free.